these topics in more detail, along with many other fundamental concepts, in the course Forex Trading, your complete guide to get started like a pro. So yes, we're reviewing the essentials here to make sure you can follow the rest of the course easily. But if you're new to trading and don't fully understand leverage, margin, position sizing, or how to grow your account sustainably, I highly recommend starting with that course first. I know many of you are eager to dive into advanced topics, but skipping the basics can hold you back in the long run. Think of it like learning tennis. You might want to rush onto the court and play matches right away, skipping the fundamentals like foot positioning, racket grip, wrist control, or shot precision. Sure, you can play and maybe even win a few games, but without mastering the fundamentals, you risk developing bad habits that will slow your progress later on. Trading works the same way. You can jump into advanced strategies and even make money at first, but without a deep understanding of the core concepts, your weaknesses will eventually catch up and cost you. That's why we're reviewing the essentials here, so you can move confidently into more advanced concepts later in the course and truly understand them. Now, as mentioned, we'll go over charts, support and resistance, trend lines, and other key points. If you're already comfortable with these topics, feel free to skip this section. But if you're a beginner or still unsure, pay close attention. Welcome once again to the course, and enjoy your trading journey. I have opened my MetaTrader 4 so we can analyze the different types of charts. Here you can see that we have 3 buttons, and they identify 3 different charts that you can use with your MetaTrader 4. The first one is called the bar chart, the second one candlestick chart, and the last one is called line chart. Let's start with the line chart because it is very easy. If the price of euro-dollar was 1.11 yesterday and it is 1.12 today, the line chart would only connect the 2 points with a line. So it is very easy to understand with a quick look if the price is going up or down. The second chart I'm going to introduce is the bar chart. While the line chart gives information only about the opening and closing prices, the bar chart also provides you with information about the high and the low for the session. The horizontal dash on the left side indicates the opening price, and the dash on the right side indicates the closing price. The vertical line gives information about high and low. The bottom of the vertical line is the lowest price reached during the session, while the top of the vertical line represents the highest point reached during the session. For example, we can have a bar like this. What kind of information can you read on this bar? You can say that at the beginning of the session the price was 1.12. During the session the price dropped to 1.1150. That is the lowest point for the session. The price also reached 1.1370. That is the peak for this session. At the end of the session the price closed at 1.1290. With a simple bar, you get a lot of information. Last chart we need to analyze is the candlestick chart that, as you may have guessed looking at the title of the course, it is the one that we are going to use. The candlestick chart is built in the same way and gives exactly the same information as the bar chart, but it is displayed in a way that you can quickly analyze the movements and the trends on the market. A candlestick looks like this. We have a vertical line that is called shadow, so we have the upper shadow and the lower shadow. Then we have a large block in the middle that is called the body or real body. The real body is usually colored to give traders a quick idea about the direction of the price. I use green candles when the price goes up and red candles when the price goes down. Another popular choice is to have white candles when the price goes up and black candles when the price goes down. I use the price example that I have used for the bar chart, so you can see that the candlestick chart is the same. The opening price is at 1.12, then the lower shadow shows a low at 1.1150, and the upper shadow shows a high at 1.1370. The price then closes at 1.1290. In addition, you have the color of the candle that gives you immediately the information that the price increased in that session. Let's see an example on the MetaTrader. Here we have euro-dollar on a daily chart. I want to analyze this candle, not the last one, because it is still live on the market and it can still form a new high or a new low. And furthermore, we don't know what will be the closing price. So I draw my lines to identify the key levels of this candle. We have the opening price, then we have the closing price here, then the low, and here we have the high. Also, there is no need to draw the lines. If you go with your mouse cursor on the candle, MetaTrader will give you all the information here. You can see OHLC, that stands for open, high, low, and close. When we talk about technical analysis, we cannot avoid to talk about support and resistance, because they are the most used concepts in forex trading. The terms support and resistance were created back in the early 1900s in the stock market. Support occurs when traders begin buying, supporting a product as it was falling. Conversely, resistance occurs when traders feel prices are getting too high or expensive and they resist buying at that price. So support and resistance are price levels or range of prices that a currency pair doesn't often go over or under. The first important thing you should notice is that support and resistance are not exact numbers. They are levels or range of prices. In this example, we can see a support. The price clearly struggles to go under 1.0850. So we say that 1.0850 is a support level. If you take a closer look, you can see that the price doesn't stop at 1.0850 and then it goes up. It goes to 1.0852 or 1.0849. So we identify 1.0850 as an area, but it doesn't mean that the price goes exactly to 1.0850 and then it goes up. Here we have a resistance instead. The price reaches 3 times 1.0950 area, but then it goes back. So you can notice that support and resistance are like a wall. When the price arrives there, it looks that it hits the wall and reverses. Why does it happen? Every market price is made by supply and demand levels. A support is simply an area where the price starts to be appealing and this increases the demand for that currency, pushing the price up. With the same logic, a resistance is an area where the price starts to be seen too high and the demand for that currency decreases, pushing the price down. What is a trend? The trend is simply the direction of the market, so which way the currency pair is moving. But when you have a look at the chart, the first thing that you notice is that there is no straight line to help you to identify any direction. You never see something like this, but you can see something like this. Even if it is quite obvious that the price is going up, how can you say that? Let's analyze this example. You need to have a look at the highs and lows that are formed on the market. In this example, we start from here and the price goes up before having a change of direction. So just focusing on these 3 points, we can say that the first one is the first low. Then the price reaches a high and then it goes back to form a second low. Then it starts to go up again and we have a new high. And then at the end, we have the price that forms the third low. Now, are these highs and lows growing? Yes, the second low has a higher price than the first one, and the third low has a higher price than the second one. The same thing for the highs. So you can say that the price is not going up as a straight line, but overall, the price is going up because new highs and new lows are higher than the previous ones. This concept defines an uptrend. When new highs and new lows are always lower than the previous ones, we have a downtrend. We also have a third type of trend, that is the situation when the price is not going up, but it's not even going down. This trend is called sideways trend. In this situation, the price moves in a range that is defined by a support at the bottom and a resistance at the top. I once had a conference about Forex trading. It was a free event organized by a broker, and they asked me to talk about Forex charts. I remember that I pointed the chart on the widescreen and I asked, "What do you see?" I got the same response, a chart. I also heard someone laughing, to be honest. The question maybe seemed to be too easy. So I asked, if you focus more on the chart, what do you see? Someone started to be interested and tried to listen carefully. Someone else suggested candlesticks instead. Well, that's correct. So once again I asked, if you focus on the candlesticks, what do you see? 10 seconds of silence. Questions started to seem harder, and no one had any idea where I was going with my questions. Someone said that we could see price movements focusing on the candlesticks. And that's correct again. I was quite proud of people there. They were right about the first three answers: charts, candlesticks, and price movements. Unfortunately, the last one is the decisive one to understand Forex market and to make money out of it. So I asked, if you focus on price movements, what do you see? Again, 10 seconds of silence, followed by someone who tried to give very exotic answers. But there's only one answer to this question, and it is supply and demand. What you see on your charts is the result of supply and demand principle. In other terms, if demand exceeds supply, the total trading volume of buyers is greater than the total trading volume of sellers, causing the price to go up. Conversely, if supply exceeds demand, the total trading volume of sellers overcomes the trading volume of buyers, causing the price to go down. When supply and demand are equal, the price will not have any direction. That's the case of sideways trend. The supply and demand law is valid for any financial market, and sometimes not only for financial markets. Let me give you an example from daily life experience. Let's go on Amazon UK and search for a GoPro Hero 5. That is a camera that I bought on the 10th of June. So it is the first one. I click on it and then I use an extension of Chrome that I have. It is called Camel, and it allows you to check the recent prices for items on Amazon. I want to have a closer look on the website, so I click here, and here we have the product on Camel page, and I want to focus on the last 3 months. So here we have a chart that shows the price for the GoPro Hero 5 on Amazon for last 3 months. I bought the GoPro on the 10th of June, so approximately here. And if you go a few days back, you can see that the price was around £350, £360, and then it went dramatically down. Now, what happens with the price here? It happens that people start to think that the price of the GoPro is very convenient, so they start to buy the GoPro. It is something that I actually did by myself. I wanted to buy a camera and I saw the GoPro at that price and I felt that it was very convenient and I bought it. So many people bought the GoPro in that period and they increased the demand for that item, pushing the price up. This was a simple example on Amazon just to give you an idea of how supply and demand work with something material. Make sure you understand this concept because all the course is built on the supply and demand law and the fight between buyers and sellers. If you have had the chance to take my first course, We have talked a lot about the participants in the Forex market. This time we are going to analyze the participants in the Forex market from a different point of view, from the perspective of supply and demand. When you buy a currency pair, you are basically increasing the demand for that couple, while when you sell a currency pair, you are increasing the supply for that couple. So we can say that buyers and sellers are responsible for the level of supply and demand. In Forex market, we can find buyers and sellers like me and you. What are we doing on the market? We speculate the market. We don't really care about fundamentals. We maybe read the economic calendar to stay away from trading when important news are released. Maybe we try to make profit trading the news, but we don't do more than that. We try to make a profit from speculating the market imbalance. What if euro-dollar pair collapses in a couple of weeks from 1.15 to 0.95? Is it going to affect us? Not at all. Even if we had a long position, we probably had a stop loss of 100 pips or less. So we don't really care if the price went down by 2,000 pips in a couple of weeks. So we can summarize our action on the market, saying that we try to make profits on the market, analyzing lower time frames, investing an amount that can go from a few $100s to hundreds of $1,000s. What kind of impact do we have on the market? Zero. Forex has about $4.1 trillion transactions every day on average. A position of $10,000 is not going to affect the market. Another category of buyers and sellers are the ones that participate in the interbank market. The interbank market is the market through which large banks transact with each other for both their customers and themselves. Among the largest players are Citicorp and JP Morgan Chase in the United States, Deutsche Bank in Germany, and HSBC in Asia. The minimum size for a position in the interbank market is $5 million, but most transactions are much larger and some can top $1 billion in a single position. If you think of a transaction of $1 billion in a market that has an average of $4.1 trillion transactions each day on average, probably is still not much. But if you think that 10 or 20 of these transactions are in the same direction, it starts to be relevant in terms of supply and demand. So throughout this course, I will talk a lot about buyers and sellers, or bulls and bears if you want to use Forex jargon. And I want you to understand that I'm not talking about me and you. We don't have any power on the market, so there's no point to study our action. When I talk about buyers and sellers, I mean the large participants in the Forex market, so the ones that can have a huge impact and can change the balance between supply and demand. They are the ones who move the market, so it makes sense to study their behavior, how price moves as a result of their actions, and formulate concepts to try to be in the same boat with them. Here we have 3 candles. I want you to have a look at them, pause the video, and then tell me what you see in terms of supply and demand. I leave you 5 seconds to pause the video or to take your time to think of your answer. For the candle A, we can say that the buyers were in control from the beginning to the end. The demand for the currency pair was higher than the supply. Regarding the candle B, we can say the opposite. It's obvious that the sellers have the power at the moment and are pushing the price down. So we say that the demand is lower than the supply for that currency pair. The candle C shows that there's an even fight between buyers and sellers. The price went up and down, creating new highs and lows for the session that we can see from the shadows, but then it closes near the opening. Supply and demand are in balance. I think that it is quite easy, but I invite you to have a look at other candles and try to make your deductions on what happened during that session. An exercise that can help, especially if you're not familiar with candlesticks, is to open your MetaTrader, select 15 minutes as a time frame, and have a look at the new candlestick from the beginning till the end. It will give you an idea of the formation process of the candlestick. So, what time frame should I use? In the first course, this has been the most popular question. My answer is always the same. It depends. If you go to a financial advisor and say, hey, I want to buy some government bonds, the first thing that the financial advisor will ask is, would you like to invest in short-term or long-term bonds? So if you ask me what time frame should I use, I will reply, it depends on your time horizon. If you want to plan long-term investments, holding your position for weeks or even months, then weekly and daily charts are good for you. In any case, I always suggest to analyze the daily chart, even if you are planning to trade on shorter time frames. Daily charts can be used to keep an eye on the market's overall direction. They say that trend is your friend, so seeing the bigger picture on the daily chart can help you to trade on lower time frames in the same direction of the prevailing trend. Unfortunately, I have seen many traders focusing on short-term price action, forgetting about the daily chart to analyze the main direction of the price. Don't do this mistake. Every morning, take 10 minutes to check your daily charts and see if something has changed. Which time frame do I use? I mainly use the 1-hour chart, and I explain you why so you can see that the reason is strictly personal. People who know me know that I decided to become a forex trader not because I want to be rich, but because I want to have time for myself. So I want to be able to work 4 or 5 hours per week without checking the charts every single hour. For this reason, I never trade on low time frames like 15 or 30 minutes. At the same time, I don't want to get bored holding my positions for weeks or months. That's why I tend to avoid daily and weekly charts. So now you know why I mainly use the hourly chart, and sometimes I also use the 4-hour chart. So once again, what time frame should you use? It depends on you. If you are very busy and don't have time to trade, you can focus on the daily chart or the 4-hour chart. If you have more time to dedicate to forex trading, you can also consider to use the hourly chart. In any case, I don't recommend time frames lower than 15 minutes because it will expose you to daily trading noise and random movements that will give you a lot of false signals. What time frame should I use? This is a question that I get a lot for any kind of trading strategy or trading system. It really depends on many factors, but I suggest you to try different time frames with this strategy and choose the one that best fits your personality and your availability. If you are a very calm person, you don't like to open many trades in the same day, you probably don't want to trade the 5 minutes and the 15 minutes charts. The same if you have a job from 8 to 5 and you only have the evening to dedicate to forex trading, you probably don't want to trade the short time frames because you don't have time to monitor them several times per day. Having said that, I'm here to help you to choose the trading style that is perfect for you. The first category of traders that I want to show you is scalper. Scalpers usually hold their trades from a few seconds to a few minutes. The goal is to get a small amount of pips per each trade. Scalpers usually focus on very low time frames like 1 minute or 5 minutes at most. This technique is a double-edged sword because it is true that you can earn money in seconds, but you can also lose money in seconds. Also, you need to consider that for small targets, the spread has a bigger impact on your positions. In addition, low time frames are very hard to read and have many false signals. If you are at the beginning of your journey as a forex trader, I would not suggest to start from here. The second category is day trader. Day traders focus on short and medium term trading, usually holding their positions for less than 1 day. The main time frames used by day traders are 15 minutes and 1 hour. If you are a kind of trader who has time to trade, who likes to trade during the day but doesn't like the crazy fast action of scalping, then day trading is for you. Last category is long-term trader. Usually this category is also subdivided in swing traders and position traders. Swing traders usually focus on 4-hour and daily charts, but sometimes they also like to use the hourly charts. I'm a swing trader, for example, and I mainly trade the 1-hour charts. Position traders give more importance to daily and weekly charts, and they usually hold their positions from several days to several months. I have studied and tested this strategy, the strategy that we are going to study in this course, with any time frame. I mainly trade it with the 15 minutes and the hourly charts. I have once opened a long-term investment that I published on my Twitter page using this strategy on the weekly charts. There is no perfect time frame for this strategy. There is only the perfect time frame for you. So spend time to think about it, try to trade all the time frames to understand which one is suitable for you, and then you're ready to apply this strategy successfully. Do you remember when we have studied how to read supply and demand on a chart? I have submitted a question: how can we know when the trend is changing and when it is confirmed? Traders watch for price clues alerting them that the trend is changing. Reversal patterns are these clues. The term reversal may lead you to think of a strong trend ending and then reversing to a new trend. This hardly ever happens. That's why I don't like the name reversal patterns, because I think it is misleading. A trend reversal signal implies that the trend may change, but not necessarily reversing. Steve Nissen is considered an expert about candlesticks, and in his book Japanese Candlestick Charting Techniques, he gives a very good example to explain how reversal patterns work. Compare a trend to a car traveling forward. The car's red brake lights go on and the car stops. The brake light was the reversal indicator showing that the prior trend, that is, the car moving forward, was about to end. But now the car is stationary. Will the driver then decide to put the car in reverse? Will he or she remain stopped? Will he or she decide to go forward again? Without more clues, we don't know. Most of the candlestick that we are going to analyze in this course will be reversal patterns, but we also have another category, the continuation patterns. A continuation pattern is one in which the market should continue to follow the same direction, so it should confirm the power of the current trend. For instance, a continuation signal following a rally means that the trend remains up, and we should expect that the buyers will continue to push the price up. With this introduction about reversal and continuation patterns, we can finally study the candlestick signals starting from the single candlestick patterns.
What does this candle say about the fight between buyers and sellers? The hammer has a small real body, so we can say that during the session there's been a pretty even balance between buyers and sellers. This is also the reason why the color of the real body is not important, it's the size of the real body that is important. Now let's have a look at conditions 2, 3 and 4 to check if this candlestick is telling us something more about the fight between bulls and bears. The real body is at the top end of the sessions range. There's a very small or no up shadow, but there is a very long lower shadow, at least twice the height of the real body. About this last condition that I've mentioned, you don't need to buy a ruler and measure the hammer every time. The MetaTrader will show you open, close, high and low prices if you just put the cursor over the candlestick. But in any case, you don't need to be super rigid about this rule, you will develop an eye for it. So the small upper shadow and the long lower shadow are saying that there hasn't been much action over the opening price, because as soon as the session started, the bears were in control and immediately pushed the price down. Before the end of the session, the bulls managed to push back the price near the opening price, recovering all the loss that they had during the session. So it is very simple so far. Sellers had control at the beginning of the session, buyers managed to push the price back by the end of the session. Now, last condition is very important and unfortunately often forgotten, so always keep it in your mind. The hammer is a very strong reversal signal when it appears in a falling market, when there is a clear downtrend. Here you can see 3 hammers appearing after a down move. What's the logic behind this pattern? In the previous sessions, the market sold off dramatically, then a hammer appears. Think about what we have said about the hammer. At the beginning of the session, the sellers are in control. So nothing new, because we have seen that in the previous sessions the price was going down, so everyone is expecting to see that the price continues to go down. But suddenly the bulls appear and they have the power to push the price back near the opening of the session. This means that after many sessions dominated by the sellers, the price has become attractive enough to convince the buyers to take action and buy the couple. To have a better understanding of this pattern, we will go inside it and check the price action that leads into the formation of a candlestick of this shape. The best way to do it is to identify a hammer and then switch to a lower time frame to check what happened over the session. Here we have dollar Japanese yen on a daily chart. We can see 3 hammers. The first 2 highlighted in green didn't really have success. The price went up after the first hammer, but then it started to go down again. The second one has the shape of a hammer, but I will not consider it after just 2 bearish sessions. I can't certainly say that the price was going down. It looks that at that point the couple was in a sideways trend more than a downtrend. Last one, the one highlighted in yellow, is the one that we are going to analyze. The candlestick that forms a hammer pattern appeared on a daily chart on the 17th April, so the best thing to do is to switch to our hourly chart and check what happened in those 24 hours. These 24 candles on a 1-hour chart formed the hammer that we have seen on the daily chart. That's exactly what we have said at the beginning about the hammer. The sellers start having control of the market, so the price is going down. At one point, the price becomes convenient for buyers to open their positions. So buyers step into the market, the demand increases, and the price goes higher. I want to clarify just last thing, because you will see in many forums that there are a lot of discussions about this. Does the color of the real body matter? Hopefully this figure will leave no other doubts. As you can see, in both cases the price went down a long way and then it came back. If you got the logic of the pattern, you understand that the important thing is that the buyers recovered from a very bad start of the session. So no, the color of the real body doesn't matter when it comes to the hammer. There can be a psychological belief that a green body is better than a red body, but in my experience the market makes no differentiation between red and green real bodies of this pattern. It's not about the color, but it's about the size. The longer the lower shadow, the shorter the upper shadow, the smaller the real body, the more meaningful the hammer will be.
I know what you're thinking. You are thinking that I'm just kidding because you have seen this pattern 5 minutes ago and I have introduced the pattern with another name, that is hammer. The hanging man has the same shape as the hammer, and actually the first 5 conditions are the same. It's only the last one that is different. In fact, the hanging man appears when the market is in an uptrend. Does it make a huge difference? Let's find out. Here we have euro-dollar on a 4-hour chart. I have highlighted in green all the candlesticks that have the same shape of a hanging man, but that do not respect the last condition. That means that they appear when there's not a clear uptrend. So we are not going to take them as hanging man. In yellow, you can see the candles that respect all the conditions, and so they need to be considered as hanging man. The best thing to do to verify the strength of this pattern is to analyze the price action before the pattern, the price action of the pattern, and then combine them and draw our conclusions. Let's analyze the price action before these 2 hanging men in yellow. In previous sessions, the price was going up, so there was a clear uptrend before that the hanging man appears. The hanging man, as a single candle, tells us the same information of the hammer. The session starts with sellers in control that push the price down. Then buyers appear and they manage to push the price up, closing the session near the opening price. So at the beginning of the session, sellers were in control. By the end of the session, buyers are in control. Combining the two analyses, we can say that buyers are in control on the market. Then with the hanging man, sellers attempt to change the trend, pushing the price down. But buyers react and then the price goes up again. So at the end of the session that defines the hanging man, the buyers are in control, not the sellers. This analysis for me is enough to let me say that I don't recommend to use the hanging man. I don't want to open short positions on a candlestick that is telling me that the buyers were stronger than the sellers by the end of the session. But why traders consider the hanging man a good reversal pattern? The first reason is that they see the hanging man as the first trace of sellers on the market. After all, the hanging man is saying that after many bullish sessions, the sellers finally made their move to push the price down, even if the buyers reacted very well by the end of the session. The second reason, and from my point of view, this is the most important one, is that many traders apply candlestick patterns the way they study them in the books, without really understanding the logic behind the pattern. Don't get me wrong, I don't want to say that I'm the only one who understands candlestick patterns. There are so many traders better than me out there, but when I was moderator for a Forex forum, I have seen many traders or aspiring traders reading the charts as if they were selling something on the street market. Hammer here, hanging man there, another hammer here, let's buy it, let's sell here on the hanging man. This is not the way I want you to trade. I want you to understand every single pattern in order that you will be able to analyze the market with your brain, even if you don't remember the name of the patterns. If we analyze the conditions needed to form the shooting star, we can see that this pattern is pretty much the opposite of the hammer. First of all, we have a small real body, just like the hammer. This time the real body is at the bottom end of the session's range. We have a very small or no lower shadow and a long upper shadow that should be at least twice the size of the height of the real body. Even for the shooting star, the color is not important. Now, last condition, as you might have guessed so far, is usually the most important one. The shooting star requires that the market is in an uptrend. So what does this candle say about the fight between buyers and sellers? The small lower shadow and the long upper shadow let us know that there hasn't been much action below the opening price and the buyers started very soon to push the price up. By the end of the session, sellers step into the market and the price goes down, closing near the opening price. In a short and easy way, we can say that buyers were in control at the beginning, but sellers have been stronger by the end of the session. Here we have euro-dollar on a daily chart. I have highlighted in green all the candlesticks that have the same shape of a shooting star, but that I would not have considered because they don't satisfy last condition. That means that they don't appear during a clear uptrend. In yellow, you can see real shooting stars. They satisfy all the conditions. Then I have highlighted one in a kind of light purple because I'm not sure about that one. It appears after a move up, even if the price is still lower than the last high that has been formed by the first shooting star in yellow. I think that at that point I would have looked for other clues to understand if it was a good signal or not. So let's analyze the price action before the shooting stars are lighted in yellow, the price action of the shooting stars, and then we can combine them to draw our conclusions. Before the shooting star, buyers are completely in control. The price is clearly going up. Then a shooting star appears. At the beginning of the shooting star, buyers push the price higher. This is not a surprise. After all, the price was going up before the shooting star, so everyone is expecting that the price continues to go up. The surprise comes when sellers step into the market and push the price back near the opening of the session. So putting it all together, buyers have been too strong for sellers in last sessions, so you can see a lot of big green candles. At one point, a shooting star appears and is telling us that the sellers ended the session stronger than the buyers. This is probably because at that point, the price started to be convenient for sellers to open their short positions. I think that now you're starting to understand better how to analyze the patterns and the supply and demand game on the market, so you also understand why the color doesn't matter. The important thing is that sellers recovered from a very bad start of the session. So, as for the hammer, it is not about the color, but about the size. The longer the upper shadow, the shorter the lower shadow, the smaller the real body, the more meaningful the shooting star will be. The inverted hammer has the same shape as a shooting star, with its long upper shadow, the small real body, and the small lower shadow. So if you compare the conditions, you will see that the first 5 are the same, but the last one changes. In fact, the inverted hammer appears after a decline, when the market is in a downtrend. Do you remember when we have seen hammer and hanging man? All the conditions were the same, but the last one was different. Here we have a similar situation between shooting star and inverted hammer. All the conditions are the same except for the last one. Does this make a huge difference? Let's see. Here we have pound dollar on a 4-hour chart. Once again, I have highlighted in green the candles with the same shape of an inverted hammer, but that are not inverted hammer because they missed the last condition. They don't appear during a downtrend. The one highlighted in yellow is a good inverted hammer. We can see that it comes after a long and strong down move. Once again, to understand the logic of the pattern, I like to analyze what happened before the pattern and what happens with the candlestick that forms the pattern. In the sessions that precede the inverted hammer, the sellers have the power, and you can see that all the candles are red. There is no trace of buyers. Then an inverted hammer appears and it tells us the same things that we have already learned from the shooting star. The buyers were completely in control at the beginning of the session and pushed the price higher till the end of the upper shadow. Then the sellers reacted and the price closed near the opening. So combining the two analyses, we can say that there is a downtrend, and then the inverted hammer at the end shows that buyers attempted to change this downtrend, but sellers reacted and the price went down again. So sellers were stronger than buyers by the end of the session. As for the hanging man, ask yourself a question. Do you want to open long positions on a candlestick that is telling you that sellers are stronger than buyers at the moment? Not at all. That's why I don't suggest to use the inverted hammer. The inverted hammer has the same shape as a shooting star, with its long upper shadow, the small real body, and the small lower shadow. So if you compare the conditions, you will see that the first 5 are the same, but the last one changes. In fact, the inverted hammer appears after a decline, when the market is in a downtrend. Do you remember when we have seen hammer and hanging man? All the conditions were the same, but the last one was different. Here we have a similar situation between shooting star and inverted hammer. All the conditions are the same except for the last one. Does this make a huge difference? Let's see. Here we have pound dollar on a 4-hour chart. Once again, I have highlighted in green the candles with the same shape of an inverted hammer, but that are not inverted hammer because they miss the last condition. They don't appear during a downtrend. The one highlighted in yellow is a good inverted hammer. We can see that it comes after a long and strong down move. Once again, to understand the logic of the pattern, I like to analyze what happened before the pattern and what happens with the candlestick that forms the pattern. In the sessions that precede the inverted hammer, the sellers have the power, and you can see that all the candles are red. There is no trace of buyers. Then an inverted hammer appears and it tells us the same things that we have already learned from the shooting star. The buyers were completely in control at the beginning of the session and pushed the price higher till the end of the upper shadow. Then the sellers reacted and the price closed near the opening. So combining the two analyses, we can say that there is a downtrend, and then the inverted hammer at the end shows that buyers attempted to change this downtrend, but sellers reacted and the price went down again. So sellers were stronger than buyers by the end of the session. As for the hanging man, ask yourself a question. Do you want to open long positions on a candlestick that is telling you that sellers are stronger than buyers at the moment? Not at all. That's why I don't suggest to use the inverted hammer. What is a dragonfly doji? A dragonfly doji is a particular doji where open and closing prices are at the top of the session. So opening price, closing price, and high are the same price. Once again, there's no need to be super rigid about these rules. If the opening and closing prices are not exactly at the top of the session, but just a few pips below the high, we can still consider it as a dragonfly doji. What is really important is the logic of the pattern. As you may have noticed, the Dragonfly Doji has more or less the same shape of a hammer, and it also appears in a downtrend. The only difference is the one regarding the real body of the candlestick, but the logic is exactly the same. Here we have pound dollar on a 4-hour chart. Can you see the Dragonfly Doji on the chart? I leave it just 5 seconds. Okay, the Dragonfly Doji is right here. So the price is in a downtrend before our pattern. Sellers are completely in control. With the Dragonfly Doji, the market sold off from the very beginning, then recovered the losses to end the session right back where it started. So by the end of the session, the buyers took over and pushed the price up. This means that after many sessions dominated by the sellers, the price has become attractive enough to convince the buyers to take action and buy the couple. So the Dragonfly Doji has exactly the same logic of the hammer, because it contains pretty much the same action that you see in a hammer. So we will use both of them in the same way during the course. When the open and close are both equal to the low of the session, we have the most bearish of doji, the gravestone doji. As for the Dragonfly Doji, there's no need to be rigid with the rules. As long as you apply the logic of the pattern to recognize where supply and demand are addressed, you will be able to read the market in the right way. So if we have a very small lower shadow, it's still fine. If we have a very small real body, well, we can still consider the candle as a gravestone doji. Talking about the Dragonfly Doji, we have said that it looks like a hammer. What about the gravestone doji? It's definitely a shooting star without a real body. You can also see that the gravestone doji appears during an uptrend, just like the shooting star. Here we have euro-dollar on a 4-hour chart. I give you 5 seconds to look for the gravestone doji. Okay, here we have the gravestone doji. If you paid close attention, you may have noticed another doji just 2 candles before the gravestone doji. The trend before the gravestone doji is clearly up. Buyers are winning the fight. The gravestone doji expresses the same concept that we have introduced with the shooting star. Buyers push the price higher from the very beginning of the session. Again, this is not a surprise because we are in an uptrend, so traders expect the price to go up. The surprise comes when sellers step into the market and manage to push the price back to the opening price. It may be that the market reached the point where the price is very convenient for the sellers, but is not so convenient for the buyers anymore. So the gravestone doji has the same logic of the shooting star, and we will use them in the same way during the course. Last doji we are going to analyze is named long-legged doji or rickshaw man. This is a doji with an open and close at the middle of the candle's range, or very close to the middle of the candle. There's no real body or a very small real body, and there are 2 long shadows that we can also call legs. That's why the name long-legged doji. This pattern has a condition that you will not find so easily in other patterns. The long-legged doji is a reversal pattern whether it appears during a downtrend or an uptrend. Let's see the reason of this condition. The long upper shadow shows that the price rallied during the session. The long lower shadow shows a market that has sold off during the session. In other words, the market rallies, sells off, rallies, sells off, and continues like this, only to close the session at the opening price. So, after a downtrend or after an uptrend, this doji indicates that there has been much uncertainty in the market after a period of directional certainty. This change of conviction may result in a change of trend. Here we have Euro-dollar on a daily chart. You can see a long-legged doji appearing at the end of an uptrend, creating uncertainty on the market. That could be the price where sellers find convenient to sell, increasing the supply and pushing the price down. Marubozu and belt hold lines. I'm pretty sure you were expecting two different patterns. Sorry to disappoint you, they are the same pattern. Traders call the single candle Marubozu, but when the candle appears at the end of the trend, they call the reversal pattern belt hold line. Since we don't really mind about the name of the pattern, we will only call this candle Marubozu. We will not use the other term belt hold lines. What is a Marubozu? A Marubozu is a candle with a long real body and no shadows. If the body of the candle is green, we have a bullish Marubozu. If the real body is red, we have a bearish Marubozu. Even for this pattern, I invite you to catch the logic behind it, so there's no need to be super rigid about the rules. If you see a very small upper shadow or a very small lower shadow, you can still consider the candle as a Marubozu. Let's consider a bullish Marubozu, for example. From the very beginning to the end of the session, buyers pushed the price higher, so this candle is the most powerful sign of buyers on the market. I want to give you an example of daily life experience because I like to show how Forex behavior is usually similar to other situations of normal life. Last Christmas, I wanted to buy a board game, so I went on Amazon and I looked for Speak Out. You probably know the game because it's become ridiculously popular last year. Anyway, the game was so popular that no seller in UK had the game anymore, and it was still November, more than 1 month before Christmas. Some days Amazon was receiving some stock like 200 pieces, but it was almost impossible to buy the game if you were not at the computer 24 hours per day, because those 200 pieces were gone in 15 minutes. Everyone wanted to make sure to have the game for Christmas. In Forex terms, we could say that buyers were increasing the demand. You can see here that the original price for the game is £21.99 in UK. By the end of November, Amazon was selling the game for £50 and the price was increasing every time Amazon received new stock. Now consider those 15 minutes that you could use to buy the game on Amazon as a Forex candlestick. The action of the buyers regarding that game can be compared to a Marubozu. Buyers start to buy from the first seconds that the board game is available on Amazon, and they only stop when the game is sold out. In Forex market, we see that buyers start to buy the couple from the beginning of the session to the end. Now the question is, if the buyers have been so active during the session and were still active by the end of the session, is it likely that they want to buy some more when the next session opens? Yes, that's why traders expect to see another bullish candle after a bullish Marubozu. So far, we have only seen reversal signals. Marubozu can be used as a reversal pattern and as a continuation one as well. If it appears going against the trend, like the one highlighted in yellow in this chart, it forms a reversal signal. Most of times this signal will be a bullish or bearish engulfing, a double candlestick pattern that we will study later on. If the Marubozu appears confirming the trend, like the two candles in this chart, it will form a continuation pattern. We have seen single candle patterns like the hammer and the shooting star. Single candles can give important information about supply and demand simply through the color, the length of the real body, and the length of the shadows. Now we are going to analyze combinations of individual candles. The engulfing pattern is a major reversal signal with two opposite color real bodies. In this lecture, we are focusing on the bullish engulfing pattern, so let's have a look at the properties. As I have already said, it is a two-candle pattern. The market then must be in a downtrend. This is the most important condition, and this time is not the last one because we need it to understand the other conditions. So the first candle must be red, in line with the previous trend that is down. The second candle must be green, with a real body that surrounds, or we can say engulfs, the real body of the first. Last one, the position of the shadows on either candles doesn't matter. What's the logic behind this pattern? We have a first candle that is confirming that sellers are in control of the market. Traders are expecting then another red candle, in line with the downtrend. But here comes a long green candle that engulfs the previous one, showing that buying pressure has overwhelmed selling pressure. Here we have United States dollar, Japanese yen on an hourly chart, and you can see that the price is going down, so sellers are in control in the first part of the chart. At the end of this downtrend, there's a bullish engulfing pattern. So analyzing the price action on the market, we can say that sellers were in control and they pushed the price down for a long time without facing any major resistance by the buyers. At one point, we can see a bullish engulfing pattern that is basically telling us that buyers had a strong reaction compared to the previous session. So the bullish engulfing pattern is a clear signal that the demand increased, maybe because the price is too low and buyers find convenient to buy. Now that you know the bullish engulfing pattern, can you imagine how the bearish engulfing pattern is? We'll see it in the next lecture. The bearish engulfing pattern is just the opposite of the bullish engulfing pattern. Let's have a look at the properties. First of all, it is a two-candle pattern. Then the market must be in an uptrend this time. The first candle then must be green, in line with the previous trend that is up, and the second candle must be red. The real body of the second candle must surround the real body of the first candle. And last one is that the position of the shadows on either candles doesn't matter. So if you got the logic of the bullish engulfing pattern, the bearish engulfing pattern will be very easy for you. Let's follow this example on dollar Swiss franc 4-hour chart. The trend is clearly up, but at one point there's a bearish engulfing pattern that is a clear signal that sellers are strong at that price and might have the power to change the trend. Just a quick tip to increase the likelihood that the engulfing pattern will succeed. The engulfing pattern becomes more significant if the first candle has a very small body and the second candle has a very long real body. This is because the first candle reflects a dissipation of the prior trend's force, and the large second real body shows an increase in force behind the new move. Tweezer's top and tweezer's bottom are the candlestick version of support and resistance. Tweezers, in fact, are two or more candles with the same highs or same lows. In an uptrend, a tweezer's top is formed when two or more consecutive highs match. In a downtrend, a tweezer's bottom is formed when two or more consecutive lows match. The logic of this pattern is that if we have two or more consecutive highs or lows, it means that that price is hard to overcome. That's why I introduced this pattern as a candlestick version of support and resistance, because it reminds me the same logic of support and resistance. Here we have euro-dollar on a 4-hour chart, and I have zoomed in to have a better view of the pattern. As you can see, euro-dollar is in an uptrend. Then there are two candles that reach the same high. Could it be that sellers are selling the currency pair at that price and buyers struggle to go over it? In this chart instead, we have pound-dollar on a 4-hour chart. You can see that sellers are in control at the beginning, but they can't break the level that is formed by the two lows of the tweezer's bottom. Last thing, I want to give you a quick tip based on my experience on the Forex market. The tweezers work better when they also form another pattern. For example, here we have a tweezer's top that also form a bearish engulfing. This one is a tweezer's bottom with a second candle that is also a long-legged doji. In general, when you have more clues that indicate the same trade to take, it is better. That's why when the tweezers also form another pattern, you have a stronger signal.
Dark cloud cover and piercing pattern are gap patterns. That means that they need a gap between two candles. What is a gap? A gap is an empty space you can see between two candlesticks. It appears on the chart because the price movements during that time have not been registered by the platform. It usually appears during the weekends because the Forex market is closed, but of course the currency rates are still moving. With this brief introduction about the gaps, we can start having a look at these two patterns. Let's start with the dark cloud cover. So the dark cloud cover is a bearish reversal pattern and it is composed of two candlesticks. The market must be in an uptrend. Once again, this condition is very important. The first candle must be green and the second candle must be red. Then the market gaps higher on the open of the second candle. So there is a gap between the first and the second candle. Last condition is that the real body of the second candle must close into the body of the first candle. Many traders also include that the second candle must close in the first half of the real body of the first candle. Okay, it looks a bit complicated, but it's not really that hard. If you can follow me just another minute, I introduce the piercing pattern and then I will show the logic of both patterns and my considerations about them. The bullish equivalent of the dark cloud cover pattern is the piercing pattern. So for this pattern, the market must be in a downtrend and the first candle must be red, in line with the downtrend. The second candle must be green, and this time the gap is a gap low. That means that the second candle starts at an opening price that is lower than the closing price of the first candle. Once again, last condition is that the second candle closes into the body of the first candle, and we may add that it needs to close above the first half of the real body of the first candle. We have always analyzed the patterns from a logical perspective, trying to understand the reason of the formation and where supply and demand may be addressed. I will give you the logical explanation for these two patterns, but this time I will also make an exception and will also provide you with an historical background because I believe that it is necessary to fully understand these two signals. Let's start with what this pattern is saying to us. The market is in a downtrend and the first candle of the piercing pattern is confirming the downtrend. When the market opens again, there is a gap low. This gap low can be considered as a question mark. It means how will traders react to this unexpected new price? The second candle of the pattern represents the answer. If the candle is able to fill the gap and also close into the real body of the first candle, that means that buyers found convenient the unexpected new price after the gap low. so they opened long positions at the new price, increasing the demand and pushing the currency pair higher. We can say the same for the dark cloud cover. The first candle is confirming the uptrend. The gap then represents the question: how will traders react to this unexpected new price? The second candle represents the answer. If the price goes down and the candle fills the gap and closes into the real body of the first candle, then sellers had a reaction to this new price. They sold the pair, increasing the supply. They look very logical, and actually they are, and they are also very good signals from my experience. But unfortunately we will not use them a lot, and we need to have a look at the historical background of candlesticks to understand why dark cloud cover and piercing pattern will not be very useful for our trading. Candlesticks are used to monitor and study the prices in any financial market. They were created in Japan to track the price of the rice, so of course they were not created initially for the forex market. Most of the patterns that you are learning in this course go beyond the forex market. They can also be applied to study other financial markets, like the stock market for example. Dark cloud cover and piercing pattern are two examples of patterns that are very useful in other financial markets, but not forex. This is simply because of a characteristic of the forex market. Forex market is open 24 hours per day. It doesn't close and then reopens the next day. So it is very hard to find gaps, and for this reason it is very hard to find these two patterns. Here we have Apple on a daily chart quoted on the Nasdaq, that is an American stock exchange. Why does this chart have so many gaps? Because Nasdaq is open from 9:30 in the morning to 4 p.m. When the market reopens at 9:30 of the following day, price might be different from the previous close. If you have a closer look at the chart, you can see a piercing pattern right here, and the signal also did a good job. Going back to the forex market, I want to express my final words about these two patterns. In my experience, it is very rare to find a dark cloud cover or a piercing pattern in a forex chart. But when they appear, they are usually powerful reversal signals, so you can definitely use them to analyze the market.
This is going to be a very quick lecture because we are not going to use any other double candle pattern. We have seen the bullish and the bearish engulfing pattern, tweezer's top and tweezer's bottom, the dark cloud cover and the piercing pattern, so you have a lot of double candle tools to face the market. I'm showing you very quickly the harami, but we are not going to use it because it is not useful in the forex market. The reason I'm showing the harami is because it is very popular and you will easily find it in any book or guide about forex trading. So I don't want you to leave a bad review saying the instructor didn't teach me the harami. Just joking. There are other double candlestick patterns that we are not going to see because they are useless in the forex market. So you have enrolled in this course, you have invested money, but above all time. And I think that the best way to repay you is to filter between good and bad patterns without wasting your time. That being said, the harami is another gap pattern. That means that it needs a gap between the two candles. Here we have a bullish harami. The first candle is in line with the previous downtrend. Then there is a gap high that is not in line with the previous trend. So the gap high is the first clue that sellers may lose their power. The second candle is a candle with a very small real body, ideally a doji. The second candle confirms the suspects that traders already had after the gap high. Sellers are losing power, and now the battle between buyers and sellers seems equal. Here we can see a bearish harami. Of course, the logic behind is the same, but this time it appears after an uptrend. We are not going to use the harami for two reasons. The first reason is that it is very rare. You will have hard times if you try to find the harami pattern in one of your charts. The second reason is that if you think about it, you don't really need to know the harami to understand that the market is in a period of uncertainty. The second candle is already a candle with a very small real body, or a doji. So the second candle by itself expresses indecision, just like we have seen for the doji. We also have other double candle patterns, most of them with a gap in between, like the upside gap 2 crows that we see here. This is like an inverted harami, and in the stock market is used more or less in the same way we use the bearish engulfing pattern. I'm stopping here talking about the double candle patterns. I could talk for hours, but we need to follow our path. So I hope you are excited to start the next part of the course. We are going to study the triple candlestick patterns, and then we are going to face the market with all we have studied so far. There are so many 3 candlestick patterns. If you buy any book about candlestick patterns, I'm sure you will find at least 6 or 7 free candlestick patterns. There's the morning star, the evening star, the morning doji star, the evening doji star, free black crows, free advancing white soldiers, and many others. Trust me, I know all of them. I have also published a guide in Italian about candlestick patterns years ago. It is very hard to surprise me with a candlestick pattern that I don't know yet. But it is just because I know these patterns that I'm not including them in this course, because I know that they are not useful for your trading. My job as instructor is not to provide you with the longest course just to say that I'm cool. My job is to see you succeeding as a forex trader, so I'm going to show you only successful candlestick patterns. Anyway, you can Google them. You have arrived so far, so I'm sure you have a great understanding of the price action, and you will probably arrive at the same conclusions that those patterns are not useful for your trading. Having said that, we are going to study 2 powerful signals, the rising and falling 3 method and the master candle. The rising 3 and the falling 3 method are both continuation patterns. Even if many times they are introduced together with other triple candlestick patterns, they are composed of 5 candles. The number 3 in their names refers to the market phases that this pattern shows. Let's start with the rising 3 method. The first phase is composed of a long green candle that confirms the uptrend. Then we have 3 falling or lateral candles that hold within the long green candle's high-low range. Ideally, we have 3 red candles with a small real body and small shadows, but it is still acceptable if one of these candles is green with a small real body or a doji. This second phase is showing a period of rest from the battle between buyers and sellers. Usually traders say that this is a consolidation phase after a strong trend. Last phase shows a strong green candle that closes above the closing price of the first candle. This means that the market is forming a new high and the uptrend is still there. What about the falling 3 method? Well, it's just the bearish counterpart of the rising 3 method, so this time we will see this pattern during a downtrend. Analyzing again the 3 phases, We have a first phase with a long red candle that confirms the downtrend. Then we have 3 rising or lateral candles that move inside the high-low range of the first candle. Once again, the ideal situation is to have 3 small green candles, but it is fine if one of these candles is a doji or a red candle with a small real body. This second phase is a consolidation of the market. Sellers are not pushing the price any farther, and buyers don't seem to have the power to react. You can also expect that the trading volume during this period is very low. It's like that sellers and buyers are playing a chess game and they are both thinking about their next move. At the end, we have a long red candle that closes below the closing price of the first candle. The market has a new low and the downtrend is still on. This chart shows pound against dollar. 4 hours is the time frame. This is a perfect example of a falling 3 method. We can see that the first candle confirms the downtrend, then we have 3 small candles within the range of the first candle. This shows that what buyers achieved in 3 sessions is less than what sellers achieved with just 1 session, that is the first candle. Last candle of this pattern shows that sellers are again on the market, pushing the price down, so the downtrend continues. A master candle is a rising or falling 3 method with more than 3 candles in the second phase, so it will look like this. This is exactly like the rising 3 method, but it has 5 candles in the second phase. It can also have 4 candles or more than 5. In my experience, this pattern works from 3 to 9 candles in the second phase. This is also reasonable. If the market stops for a few sessions, we can suppose that it is a consolidation period. If there are many sessions that express indecision, it may be that the power of the previous trend is decreasing. So we will use this pattern only if in the second phase there will be from 3 to 9 candles. With 3 candles, that is the case of a rising or falling 3 method. We call master candle the first candle that identifies the trading range that you can see between the 2 dashed lines in red. We will also call the entire pattern master candle for the sake of simplicity. Let's see some examples on the market. Here we have euro-dollar on a 4-hour chart. There's a clear uptrend before the formation of a master candle. The second phase is highlighted in yellow and it counts 9 candles. Last candle of the pattern breaks the high-low range of the first candle and the price continues to follow the uptrend. Same situation on this 4-hour chart. This time we have pound dollar. The second phase, highlighted in yellow, is composed of 4 candles this time. Last candle breaks high and conclude this continuation pattern.
In this video we are going to focus on the candlesticks, so I'm not opening any trades. You will have the section with the live trades later on in this course. For now, I want you to understand how to analyze the market with the tools that you have studied so far. Now that you know all the candlestick patterns, it may be easy for you to recognize them if I show you a picture of a pattern, but maybe it is not so easy when you have an entire chart in front of you. Hopefully, after practicing with this chart, you will feel more confident. So let's analyze the chart together. Here we have pound dollar on a daily chart, and the first thing you need to do is to identify the trend, because we have seen that all the patterns, or almost all the patterns, need a direction to be identified. For example, you can't find any bullish engulfing pattern if the price is already moving up, or you will not find any shooting star if the price is already going down. So before analyzing the single candlesticks, it is important to understand if the currency pair is in an uptrend, a downtrend or a sideways trend. We can zoom in to have a better view of the candlesticks, and we can start to analyze the currency pair from the very beginning of the up channel. So in the first phase, the price is going up. It is quite obvious because we have many long green candles on the market. There's a tweezer stop here, but in any case I'm not going to open any short position with the pair that is in an uptrend. The first important red candle is here, but in any case the green candle that precedes the red candle is bigger, so we don't have a significant clue to say that sellers are stronger than buyers at this point. But at least with this red candle we can start to think that sellers may find convenient that price. After that we have some small candles and another red candle here, but then the price starts to go up again. When the price reaches the top of the channel, we have a bearish engulfing pattern, that is this one, with the second candle that pushes the price down. Here I would probably start to think that this might be the beginning of a retracement of the price, so the price is going a bit down after a long rally. It's like that buyers made their move and now they're taking a breath. Another thing that is very interesting to analyze is that this bearish engulfing pattern appears at the same price of that long red candle that I have analyzed before. I said that it was the first significant candle, and probably it was a sign that sellers find convenient to sell at that price. And here we are again with sellers that take the chance to sell the couple at this price again. Actually we can see that the price goes down, and here we find a doji on the market. What does this doji say? The same thing that any doji says. There's indecision on the market. You can see that after the doji there's a lateral phase on the market, with the price that is not going up, is not going down, it is just following a minor sideways trend. After this doji, you can see that in this session, sellers tried to push the price down, but buyers reacted. And the opposite happened in this candle, with buyers that made their move but sellers managed to close near the opening. So it is a lateral phase in which buyers and sellers are trying to take control of the market, but no one is prevailing for now. Then we have the price going down again. It is quite easy to recognize the down movement because of all these red candles here. At the end of this down movement we have a hammer that is also near the bottom of the channel, so this is a pattern that I want to consider to open a long position on the market. I don't particularly like that the real body is that big, even if it is easy to see that the lower shadow is at least the double of the length of the real body. So at this point I start to think that buyers are stepping into the market and they may have the power to push the price up, following the uptrend. At least for the first following sessions I was not right, because the price continues to go down a bit more. At this point we have two dojis that may indicate that the retracement is coming to an end, because a doji expresses indecision, and here we have two dojis that are also near the bottom of the up channel, so this is a very positive signal. The price starts to go up again, then there's a red candle, and this gives me another clue that buyers are strong. You can see that this red candle has a long lower shadow, so it means that sellers were pushing the price down, but buyers reacted. This means that for sellers it's hard to go below this price, because they find the resistance of the buyers. After that candle there's a very strong green candle that also forms a bullish engulfing pattern. The price goes up without any huge problem, and the first pattern that we face that shows a trace of sellers on the market is here with the two candles that can be confused with a bearish engulfing pattern. Honestly, I wouldn't consider this one as a bearish engulfing pattern, because you can see that at this point there's a very low volatility and the candles are very small if you compare them with the previous ones. So this pattern is not so significant because the shadows and the real body are very small, and this means that the market was just quiet at that moment. I'm glad that we have studied the pattern in a very logic way, so you are able to understand the market without just saying, oh, there's a bearish engulfing pattern, I need to sell the currency pair. Then going on, we have other two green candles that confirm the uptrend, but then we have a strong red candle that also forms a bearish engulfing pattern. So at this point I would be a bit worried for my long position, and I will monitor carefully next sessions. Buyers immediately react in the next sessions. You can see three green candles that almost recover the loss caused by the long red candle. Then we have a doji almost at the same price of the bearish engulfing pattern, and this is not good for my long position because it confirms that at that level sellers may find convenient to place their short positions. I want to draw a line to check this price because I also think that it has been an important level in the past. Actually, there's a doji at this price, then a bearish engulfing pattern, and then the lateral area that we have identified before, and this price matches with the resistance of the minor sideways trend. So my suspicions proved to be well founded. At this price level, sellers seem to find convenient selling the couple, and actually the price starts to go down again. Okay, so I can cancel this line now and analyze what we have at the end of this down move. We have another doji, again near the uptrend line that defines the bottom of the up channel, and you can see that the price starts to go up again. So it is a very interesting battle between buyers and sellers. It looks that buyers are in control, and in general the price is following this up channel. We have already identified three price levels where buyers push the price higher. The first one is at the beginning, where the price goes up forming very strong green candles. Then again buyers find convenience opening their long positions on the uptrend line here, and now after the doji the price is going up again. There are also levels where sellers find convenient to place their short positions, and they manage to push the price down. But I will say that buyers are stronger, especially because the price is forming higher lows that is typical of an uptrend. Let's continue the lecture having a look at the second part of the chart. We have here a very strong green candle. Probably there has been a news at this point that also helped the price to go higher, and actually you can see that the price hit the top of the channel before going back, forming this upper shadow. What happens next? We have a red candle and a small green candle that has the same shape of a shooting star, even if it doesn't appear at the end of the uptrend, because it is at a lower price. There isn't a clear signal at this point that sellers are taking control. Going on, we see that there are around 5-6 candles that express indecision after the strong up move. This candle can be considered as a master candle. I draw the lines and you can see that it is bigger than all the following candles. We have 1, 2, 3, 4, 5, 6, 7, 8, so 7 candles with the 8th candle that is breaking the high-low range of the master candle. So this is a continuation pattern and we can expect the price to go higher. So I'm going to cancel these two lines and we can see what happens after this continuation pattern. The price actually goes higher as I expected, and it is trading near the top of the channel, so the uptrend is quite strong at the moment. Then we have this candle that may be considered as a long-legged doji, even if it has a small real body, so the price doesn't close exactly at the opening level, but anyway the logic behind is the same. It is quite easy to see that buyers and sellers were fighting a lot, and the price closes almost at the opening price. The following session is a bullish candle that confirms that buyers are still on the market, pushing the price higher, so the market continues to trade near the top of the up channel. Then there's a gap low, and we have a very rare pattern that we have also studied during the course. That is the Harami pattern. I'm not going to consider this pattern, but at least I can say that with this gap low, I want to monitor carefully what happens in the next sessions. There is this long red candle that leaves no doubt. The price is starting to go down. This is also confirmed by the next candle, that is another long red candle. Let's go on to check what happens next on the market. The price seems to go a bit higher even if there is no strong move. Actually, you can see that here we have other candles that express indecision. This is also normal, we are in the middle of the up channel, so it's not a good idea to open here long positions, and it's not convenient to open short positions. Of course, if I still have my long positions, I can decide to keep them because we are still in an uptrend, but maybe we are in a retracement phase and the price is going down to the bottom of the channel. The retracement seems to be real because after a short period where the price goes up, there's another strong red candle that forms another bearish engulfing pattern that pushes the price down. So at this point I expect that the price continues to go down to reach the bottom of the channel. Then we have alternate candles. We have a small red candle, a green candle, then another red candle followed by another green candle, and then we have a doji. So in this phase I'm not getting something significant from the market. I'm not getting any strong signal to place my long trade. Then there are two red candles that push the price down to the bottom of the channel. You can see that this shadow hits the bottom of the channel. This is a good price to open a long position, but of course I want to wait for a signal, and unfortunately all the following candles are not strong enough to let me think that buyers are taking control of the market again. So I wouldn't open any long trade at this point. I can't see any good reason except for the up channel. Going on, we can see that the price goes up again. There hasn't been any clear signal to buy the couple, but most of the candles are green and they are also quite strong, so the price continues to follow the uptrend. Here we have a tweezer stop with the second candle that is also a doji, so this is a double bearish signal, and it actually worked because the retracement starts right after the combination of bearish patterns. Then the price starts to go up again, heading to the top of the channel. At the end of the chart we have two candles that can be considered shooting stars, especially the second one because it has a very small lower shadow. So we are at the top of the channel and we have two shooting stars. I will take my profit from my long positions and check what happens next, because these two patterns are warning me that sellers are starting to step into the market and a retracement may start very soon. So we can go on and we can see that actually the price goes down and there are two long red candles, with the first one that also forms a bearish engulfing pattern. After the pattern we have another strong red candle, so the analysis was correct, the price is going to the bottom of the channel again. Then we have two small candles, another red candle that pushes the price even lower, then other three small candles, another one here, and then the price goes definitely down, reaching the bottom of the channel. This is not a surprise, we were expecting the price to reach the bottom. Also you can notice that there is a master candle here, even if this shadow is going lower than the bottom level, but the logic is still the same. You can see that after this candle that continues to push the price down, there is a period of indecision with candlestick with a very small real body. Then there is a red candle and another red candle that breaks the high-low range formed by the master candle. I delete these two lines and we can see the end of this chart with today's candle that is still going on. For now it looks like a doji, a long-legged doji to be more accurate. If it is closing like this, I'm going to consider a long position. I'm always happy when I find a good signal that also gets along with the main trend on the market. So I will have the chance to buy at the bottom of this up channel. So I know I've been a bit repetitive in this video. This is also because we have sometimes found the same pattern, like the bullish or bearish engulfing pattern that is quite common in situation of a clear trend. But this was necessary. I want you to turn your brain on when you analyze the market. Many traders just have a quick look at the chart and say, oh, there is an uptrend, the moving average is like this, the stochastic oscillator is like this, so everything is fine. And in 20 seconds they have already analyzed the chart. I will never stop saying this. Forex trading is a real and a serious business. You will not make any money opening the chart for 20 seconds and use a predetermined scheme without applying yourself. So I hope you are still focused after this long analysis, because we are approaching the part of the course where we will see how to open a trade using different methods and different indicators. So excited to get there. Where should I place the stop loss and the take profit? I receive this question almost every day. It is quite funny because sometimes people send me a picture of their trade and ask me where to put the stop loss and the take profit, forgetting that stop loss and take profit should be placed before opening the trade, because they are a fundamental part of money and risk management. So where should you place the stop loss and the take profit? Of course, there is no one-size-fits-all answer to this question, but I can share with you some important concepts to understand where to place stop loss and take profit, and I'm sure that by the end of this video you will completely understand how to place them, so I will not get your emails anymore. Just joking. Let's start with the stop loss, and I also want to take 30 seconds to explain why I want to start with the stop loss. People approach forex trading almost for one reason: to make money. So even expert traders, most of times when they open a new position, tend to put the attention to the potential reward that they can get. This is completely normal from a psychological view. Everyone here wants to get money trading the forex market, so it's normal to think of opening a position and get money out of it. But I want to share with you one of the most important tips that a top investor like Warren Buffett can give to you. First rule, never lose money. Second rule, never forget rule number 1. In my opinion, it is always better to focus on the money that you are risking rather than the money that you can earn. That's why I want to start with the stop loss and then have a look at the take profit. First advice to place your stop loss is choose a level that the price doesn't reach so easily. The second advice is place your stop loss at a level that proves that your analysis was wrong. How many times you see on forex forums traders writing, "The price always hits my stop loss and then goes back in the direction of the trade I placed." Don't let a random movement or a random news to catch your stop loss. Place it in an area that nullifies your original setup, so you will know that if the price goes there, it is because you were wrong about the trend of the market and the price is following the opposite direction. So with the first two advice, I'm basically trying to let you avoid a mistake that many aspiring traders make. They want to have the stop loss close to the entry level because in this way they can trade with a bigger position and they can try to make more money. For example, if the correct stop loss is 20 pips and a trader wants to risk $200, in this case every pip will have a value of $10. Now, traders sometimes think that if they choose a stop loss of 10 pips instead of 20 pips, they can double their position, having a value per pip of $20 and still risking $200. This is wrong. A random movement can catch your stop loss in minutes and you only end up with less money in your trading balance. If the first two advice were too conservative and you may want to put your stop loss very far from the entry level now, here I come with the last advice. Don't place an unrealistically large stop loss. I give you this advice because at the moment you need to choose the take profit, you will have problems with the risk to reward ratio if you place your stop loss too far. This may look as a contradiction of the first two, but with the following example you will see that you can balance them and everything makes sense. So here we have Canadian dollar against the Japanese yen on a 1 hour chart. I have drawn this downtrend line, so the reason of the trade is quite simple. I want to open a short position when the price is close to the downtrend line. So the first time I considered a short position was here, because you can see that the price hits the trend line and then goes back, so sellers were quite strong by the end of the session. But I couldn't find any good signal on the market. Maybe this one that is a bearish engulfing pattern, or here a shooting star, but they are quite far from the downtrend line, so I missed the chance here. Another good opportunity came here with this bearish engulfing pattern that is very close to the downtrend line, and actually I took the chance to open my short position. I have already drawn the entry level and stop loss lines that I took for this trade, so I only need to do like this, and here we have the two lines. The light blue line is the entry and the red line is the stop loss. Let's have a look at the stop loss. Does it respect the three main concepts that we have seen? First of all, place the stop loss at a level that the price doesn't reach so easily. For the past price action, I will say that the price was in a kind of sideways trend and the top price has been reached with this candle. That is quite far from my stop loss level. So definitely I will say that the stop loss is in an area that the price doesn't reach so easily. Then we need to check if the original trading idea will be wrong in case the price hits the stop loss. The idea is to trade according to the current trend that is expressed by this trend line. So if the price breaks the trend line, of course my idea wouldn't be valid anymore. Now, I don't place the stop loss right after the trend line, because remember that the trend line, despite the name line, it is an area, so I can expect that the price goes a few pips higher than this line. Let's check last advice that I have given to you. Is this stop loss unrealistically too far from the entry level? Of course not. The stop loss is 50 pips far from the entry level, and for this trade I'm aiming for at least 50 pips of profit, but actually I remember that I placed a take profit of 100 pips, getting a risk to reward ratio of 1 to 2. Okay, so everything should be clear about the stop loss, but we also need to have a look at how to place the best take profit for our trades. In the first course, we have talked a lot about money management and risk to reward. We have also seen some examples with a risk to reward ratio of 1 to 1 that may be fine for some strategies. But you know that I don't like anything that goes below a 1 to 2 risk to reward, and I strongly recommend to choose a risk to reward ratio of 1 to 2 or higher for your trades. Having said that, every single trade should be analyzed on its own, because you will never find the exact same situation on the market for two different trades. But I can give you a simple 2-step guideline to help you to choose the best take profit for every single trade. First step, place a take profit that is twice your stop loss in order to have a risk to reward of 1 to 2. Second step, analyze if it is correct, if it is too far or too close. This second step needs further explanations, so I'm going to open again the previous chart on the MetaTrader. The first thing I'm going to do is to draw my take profit line. So my stop loss is 50 pips, my take profit will be 100 pips for now. I want to change the value and I also want to change the color because this is my take profit line, so I want a green color. Okay, I need to analyze if this take profit is correct. if it is too far or too close. This can also be expressed by three questions. Is my take profit at a good level? Is my take profit at an unrealistic level that the price will not reach so easily? Am I missing a chance to get more pips and so a better take profit? Let's check if this take profit is correct, analyzing the past action of the price. Every time that the price went down from the downtrend line, the price went down by 80-90 pips. Also, I need to consider that since the downtrend has started, the currency pair has already lost almost 200 pips. So, is a 100 pips take profit reasonable? Of course it is. Usually the price goes down by 80-90 pips from the downtrend lines, and there are signals that are telling me that the downtrend is likely to continue. So 100 pips is acceptable as a take profit. What if the take profit was too far? In this case you can only do two things. You can decide to lower your take profit, or you can decide not to open the trade at all. In these situations, I always opt for the second solution, but if you still want to open the trade, make sure not to go below a 1-to-1 risk to reward ratio at least. If the trade is not giving you a good risk to reward ratio, it is not worth taking. What if the take profit was too close? If you have analyzed the market and have seen that a take profit that is twice your stop loss still seems too close, then you have the chance to increase the take profit and have an even better risk to reward ratio. For this trade, I can't realistically increase my take profit because I have seen that usually the down movements from the trend lines are about 80-90 pips, and I already have a take profit of 100 pips, so it's not realistic to increase my take profit in this scenario. I consider this lecture one of the most important lectures of the entire course. So if you still have some doubts, please ask questions in the discussion board. You can also post your trade and have a second opinion from me or from other students.
Here we have Euro-Dollar on a 1-hour chart. The support that I have drawn in red is quite easy to see. At the beginning of the chart, the price goes there several times, and we can see that this level always rejects the price. After the action in the first part of the chart, we can say that 1.0855 is a level where buyers find convenient to buy the couple. The demand always increases when the price is near that level. So what we are going to do is to study the price action when the market reaches that level again. Going on with the chart, the first time that we can start to study the candlesticks is here, because the price is getting closer to our support. I want to zoom in so we can have a better view of the candles. What do we have right here on the support? We have a hammer. The lower shadow says that the price went deep into our support area, but then the price closed above the opening. So this is a good opportunity to get a long position, and I'm going to draw my line that represents the entry level at 1.0860. Also, if we think in terms of risk to reward opportunity, this is a huge chance. We are very close to our support, and we can place a tight stop loss, playing with a risk to reward that is very convenient. Think of my suggestions I have given to you placing the stop loss. I want you to place the stop loss in an area that proves that your analysis was wrong. Our trading idea is based on the assumption that the support is going to hold and reject all the attempts of the sellers to break this area and push the price lower. So if the price goes below the support area, our trading idea won't be valid anymore. This means that we can place a stop loss right here below the support, and you can see that we are risking about 25 pips. So I'm going to adjust the price at 1.0835 and color the line in red. So for this trade, we only risk 25 pips. Following my tips about the take profit, I want to place my line here 50 pips above the entry level in order to have a risk to reward of 1 to 2. Now, is this line too far from our entry level? I will say no, the price can reach this level. It was actually at that level 24 hours earlier. Is the price too close to the entry level? I will say yes this time. The chart shows that the price can go higher than 1.0910, so this time I'm going to increase my take profit and have a better risk to reward ratio. I place my take profit here at 1.0960, so 100 pips far from the entry point. In this way, I have a risk to reward of 1 to 4 that is pretty good. Let's go on with the chart to see what happens. Okay, so at the end we get our profit here, but let's analyze what happened in between. After the hammer, the price starts to go up. This is quite good because it means that the analysis was correct. Then there are several candles that push the price down, and with this candle we are very close to our stop loss. From one side, I will be worried at this point. From another side, I have another signal right on the support. I have this bullish engulfing pattern that once again is confirming that buyers are stepping into the market when the price is around 1.0855. Then nothing really happens till this candle that represents a turning point for this trade. The price finally goes up and leaves the support area behind. After this candle, buyers are completely in control of the market, and nothing stops them from reaching the take profit that I have placed. Actually, the action of the buyer is pretty strong, and I would say that the price can go even higher than this. If we go on, we can clearly see that there was a chance to get an even better profit, but I can't really complain even if I missed the chance. It was anyway a good trade. Here we have Australian dollar against the United States dollar on a 4-hour chart. I have identified this downtrend line that connects 3 lower highs. Of course, in the space within the first 2 highs, I cannot be sure that there's a downtrend, but after the price forms a lower high and then goes down again, I'm sure that the market is in a downtrend. How beautiful is this chart? This is a great example of how understanding candlesticks can give you a clear picture of the market. Here, right on the trend line, we have a shooting star that inaugurates a new down move. I wouldn't have taken this one because I could not be sure that the price was in a downtrend, but look at this, again on the trend line. We have a first bearish engulfing pattern here with a long upper shadow that is telling me that buyers failed the attempt to push the price over the trend line. Then a second bearish engulfing pattern here, again on the downtrend line. This is beautiful. I look like a kid recording this video. It is just because Forex trading has usually the tag to be a difficult topic, especially when we talk about technical analysis. So I'm happy to share with you this kind of approach to the market, and I'm happy if this can help you to make your life easier when you analyze the charts. So coming back to our analysis, I actually opened a short position on this pair right after this candle. If this candle doesn't look so clear to you, this pattern leaves no doubts, and you could have opened a position at least after this bearish engulfing pattern. Let's analyze the position I have taken on the market. The entry level is quite easy. I won my trade right after this candle, so I took 0.7530. As you know, I like to get my trade with a price that ends with 0 or 5, so I can calculate my stop loss and take profit faster. Now I have to decide where to place my stop loss. I want my stop loss over this trend line. So I decided that 0.7570 is a good level, because if the price reaches my stop loss, my downtrend line is clearly not working anymore. So I have a risk of 40 pips, and I'm going to draw my take profit line 80 pips below my entry level in order to have a risk to reward of 1 to 2. Is this price too far from my entry point? It is not too far. The price has already tested this level in the past, and we are also in a downtrend, so I expect that the price can go even lower than this. Is the take profit too close to my entry level? Maybe yes. I can increase my take profit because, as I said, I expect the price to go lower than this level because we are in a downtrend and I expect the price to form a new low. I move my take profit by other 40 pips, so I have a risk to reward of 1 to 3, and this level seems fair. I think that the price can reach this line if the downtrend continues. So this was my position. Let's see what happened. Well, this is just amazing. I wish I could have trades like this every day. The price went immediately down and reached my take profit in about half day.
Here we have euro-dollar on a 4-hour chart, and you can see that I have drawn a channel, an up channel to be more accurate, to identify the uptrend. Maybe it is not so clear on this 4-hour chart, so I switched to the daily chart to give you a better view of this up channel. Okay, let's go back to the 4-hour chart to check when this uptrend started. So I need to go back, and you can see that it's quite a long time ago. We can say that it started here, but of course at this point of the chart we couldn't know that an uptrend was taking place. We could find out about the new uptrend only after several days with other clues on the market. For now we can only say that the price hit the bottom of this uptrend line many times, then going on the price hit again the same level here. The price goes up then and it hits the top of the channel that I have drawn. By this time I could start to figure out that the pair was in an uptrend. I'm talking about the end of May. If I couldn't identify the up channel, at least I had my uptrend line at the bottom, which is quite clear because you can see that the price went there many times, like at the beginning or going on another time here. So at least we had a hint of this new uptrend simply following our trend line. So starting from this part of the chart, I will look for long positions at the bottom of the channel. That means that I want to buy euro-dollar when the price is convenient, because we are in an uptrend. So what I'm basically going to do is to monitor this line here and check the reaction of the market when the price is near that level. The first time that I'm going to monitor the price and look for trade opportunities is here. The price goes on the line and I can start to study the candlesticks to check if there's a good opportunity to enter my long trade. So there are two long red candles and we have another red candlestick on the line. For now there's no clear signal to buy the currency pair. Even going on, we have 3 small candles, so we can imagine that the market is taking a breath and the battle between sellers and buyers is even, and they are preparing the next move. Actually, this could be the first signal to buy the couple, because it looks quite suspicious to me that the price is coming from a bearish retracement and it stops right on the uptrend line. For me, this is the first time during the bearish retracement when sellers realize that they need to be careful at this price. Then we have this long green candle that forms a bullish engulfing pattern, because it engulfs the previous candle, actually not only the last one but the last 4. So I can open a long position after this pattern. It perfectly makes sense. I studied the market to find out that euro-dollar is in an uptrend, so I was waiting for a good opportunity to buy at the bottom of the channel. Then a bullish engulfing pattern shows up and is telling me that buyers are strong again and they push the price higher. So, how to consider a position with this bullish engulfing pattern? First of all, I'm going to draw my lines, one for the entry, one for the stop loss, and one for the take profit. The first one is my entry, and I want to set the price at 1.1165, that is the price that I want. I also color my line with a light blue, so it is clear that it is the line that identifies my entry level. So this line here on the MetaTrader is my entry level, after this bullish engulfing pattern. Then I need to decide my stop loss and my take profit. Let's talk about the stop loss first. I want to place it below the channel, and if it is possible, below the previous low. So what I need to do is to look for my previous low, and it is quite easy to find it. I can see that it is here, so my line will be here, but I want to color my line in red because this will be my stop loss. Also, I'm going to look for other recent lows, like this one that is not very distant, just about 3 weeks earlier. So I will draw another line on this low. And another consideration is that whatever stop loss I'm going to choose, it will not be at the same point of the previous low. Of course I will move the stop loss below the previous low, because I want to set my stop loss in an area that the price doesn't reach very often. So let's say that this one is 1.1131, I will change it with 1.1120, and that's it. We have the line here now. This one is 1.1108, and I will change it with 1.1095, for example, so below the last low. Okay, so I need to decide which one I want to choose as my stop loss for this position. Both of them look fine for this trade, but I'm going to choose the lowest one for a very simple reason. I can have a very huge take profit because the top of this up channel is very far, so I don't have any problem in terms of risk to reward ratio. Even choosing the lowest stop loss, I will still have a convenient risk to reward ratio. If I choose this one, I'm going to risk 70 pips, but you can see here, at this point, we are near 1.13, that is more than 135 pips. But I can go even higher because the top of the channel is still far from this point, so I will have a very good risk to reward ratio. So I can have a larger stop loss this time, trying to avoid that a random movement will hit my stop loss before the price continues to follow the uptrend. So I delete the first stop loss. About the take profit, I do like this to check the top of the channel, so I can choose a take profit near the top of the channel. I don't really like to have the take profit at the top of the channel, because remember that the trend lines, like support and resistance, are areas, not just lines that the price hits and then comes back. So I'm not expecting the price to hit the line every time, but I expect the price to reach an area near the top of this up channel. So I can place my take profit around here at 1.1435, and I'm going to fix the price, and I'm also changing the color of the line with a green color because this is my take profit. So at this point I will have a risk in terms of pips, that is 70 pips, but I will have a potential reward that is 270 pips, so a bit less than a 1-to-4 as a risk to reward. So let's check how this trade was going. I go back to my normal chart so we can better analyze the candlesticks. I can zoom in maybe. No, actually I think it is fine like this, otherwise we will lose the view of the big picture on the market. At the beginning of the trade everything seems fine. I have a small red candle after the bullish engulfing pattern, but then I have a strong green candle that confirms that my trade is correct. Then I can see that the price goes back, and here I can start to be a bit worried, even because this red candle goes below my last low, so I'm not very happy at this point of the trade. But I can't expect that every trade starts well, otherwise there's no need to set a stop loss. Going on, I can see that the trade went up again, but honestly I wouldn't be too happy about that, because okay, my trade is going up again, it is near my entry level and this is good, but you can see that it is outside of the uptrend channel, and this is not very good. I don't expect the price to be 100% of the times in my channels. When I draw a channel, I try to include 90–95% of the time that the price has spent in that level. So it's still fine if the price is out of the channel for a while, but then I need it to go back to the channel. Otherwise, I can start to think that the price has broken the channel. So for now, I'm not losing the trade. It is even, but I'm a bit worried. Going on, I can see that the price goes back to the channel, first of all. There's this first candle that is almost a Marubozu, and it is very important because it pushes the price back to the channel. Then I have a second candle that is almost a Marubozu again. So after these two candles, I'm very confident that my analysis of the market was correct, and the euro-dollar is following this uptrend. Then from here, everything becomes easy. I could be a bit scared by this candle. Probably it was a news that pushed the price down, but then it closes near the open, and actually this is another confirmation for me that buyers are strong on the market. Then the price continues to go higher and hits my take profit at 1.1435, giving me a reward that is almost 4 times my risk. So the trade has been successful. We haven't used any magic trick to analyze the market. We only used the chart and our brain, I would say.
I want to spend just 2 minutes to talk about my brokers and my account before opening some live trades. This is the account that I have created for the courses that I have on Udemy, so most of the times you will see me trading with this account when I record a video for my students. I have deposited £10,000 and I will use this live account just to show example of trades that are related to the course. I will not make any withdrawal or deposit, or at least not for now. Having said that, this is not my main account. I have my main account with LMAX that you see here. Then I also have another account with IG Markets, and I'm testing just with a demo account for now, XTB, that is completely new to me. I like to have multiple accounts and diversify my risk even in this way, because even if I trust these brokers, you never know. For example, some years ago, I had an account with ATC brokers that I used to consider the best broker ever seen. Then they got into some troubles and declared bankruptcy. It didn't affect me directly because I have been able to withdraw my money, but I'm not sure if it has been that easy for US traders. Anyway, after that situation, I started to have more than one broker. So why did I deposit some money into Oanda account instead of using my main account? There are several reasons. The first one is that I live off forex trading and I need to withdraw some money from time to time. So my main account is not easy to follow because I often withdraw money and I also adjust frequently my positions to my new balance. Also, I have some long-term investments that can create confusion if mixed with short-term trades. Another reason is that I don't want to put myself under pressure showing my results and my income to thousands of students. You know that forex trading is a psychological game. At least with my main account, I want to trade with peace of mind. Having said that, I don't want to avoid my responsibilities. I am an instructor, so I need to prove that what I teach is applicable and you can make money out of it. That's why I created this account. So I will show you live trades with it, and hopefully I will be able to let it grow month by month. Here we have United States dollar against the Swiss franc on a daily chart. You can see that there is a downtrend that is going on since the end of last year, so I consider it as a main trend. Switching to the 30 minutes chart, it is quite clear that during last 7-8 days, the currency pair is trading within a range that I have identified with this channel. Remember that the main trend is down, so I'm looking for short positions, and of course I'd like to open my short position near the top of the channel. The market has formed a bearish engulfing pattern. If I zoom in, it's more clear. So I took the chance to open a short position after this bearish signal. I needed to study the entry level, the stop loss and the take profit. I have already my position on the market, so I only need to do like this and I have all my lines here. The entry level is quite easy. I want to get my position right after the bearish engulfing pattern, so I open my position right here at 0.9675. I want to place then a stop loss that goes above my channel, so above 0.9690. 25 pips from here should be fine, so 0.97 will be my stop loss. Let's follow the tips I have given to you regarding the take profit, so I decided to place my take profit at 0.9625, so my take profit is twice my stop loss for now. Then I need to analyze this take profit. Should I decrease it? I can't see any reason to do it. I would only have a worse risk to reward ratio. Should I increase my take profit? Maybe I can increase my take profit by 10-15 pips, but not more than that, otherwise it will go outside my channel. Anyway, I decided to keep my position like this. It is going down pretty fast. I didn't even have time to record this video that the couple is already down by 30 pips more or less. Anyway, we will see the results of this trade at the end. Okay, so the trade went very well. We started here with a short position on this bearish engulfing pattern at the top of the channel, and we ended here, getting our take profit about 1.5 days later. Well, what to say about this position? There has been a phase in which the pair has traded in this range of about 20-25 pips, but there hasn't been any signal that my trade was wrong. Let's check the trade on the web platform. Here we have United States dollar against the Swiss franc, and I got about 2% of profit, risking only 1% of my account. Here we have United States dollar against Canadian dollar on a daily chart. It's easy to see that the price is in a strong downtrend. The buyers try to break this downtrend here, but now the price is going down again. Switching to a 30 minutes chart, I have identified this down channel that incorporates price movements for the past 2 weeks. Since I have a down channel, the strategy is quite easy. I'm going to look for a bearish signal at the top of the channel. Right here, I have 3 good candles. I have a doji, followed by another doji, followed by a long red candle that forms a bearish engulfing pattern with the previous candle. So I'm going to open my position right after this bearish engulfing pattern. This is my entry at 1.2530. Then I want to place my stop loss outside the channel, so 1.2555 should be okay, because I also want to place my stop loss over this high here. Following my tips about the take profit, I start to place my take profit here at 1.2480, so I have a risk to reward of 1 to 2. Of course, the price can reach this level, so there's no point to decrease my take profit. But maybe I can increase it because I'm still far from the bottom of the channel. So I'm going to move my take profit by other 25 pips at 1.2455. Let's analyze what happened to our trade on United States dollar, Canadian dollar. You can see that it didn't go very well and I lost my position in a couple of hours. I'm glad that I took this trade for 3 reasons. The first one is that I don't want to give you the idea that it is easy to make money on forex trading and that you will always win your trades. This is not my first losing position and it won't be my last one. You need to accept that from time to time you will lose your trades. You can't be right 100% of times. The second reason is that you can see the importance of the stop loss. Without it, I would still have the position on the market with a loss that is at least twice the one that I had. Last reason is that I made a mistake and I'm glad that I can share this mistake with you so you can avoid it in the future. I simply didn't have a look at the economic calendar for today and I forgot that there were 2 important news for the dollar right after my trade. You can see that the news were pretty important and they were positive for the United States dollar, so I didn't have many chances to survive with a stop loss of 25 pips. So going on the web platform, I have my trade here and you can see that it didn't go very well this time. In this video, I'm going to analyze Australian dollar Swiss franc on a 4-hour chart. This is not a currency pair that I usually trade, but here we have a very good opportunity. We have a very strong support here. If I zoom out, you can see that it also worked in the past. And then we have a bullish engulfing pattern right on the support. I want to open a market order, a buy market order. So I want to select this price right here. I want this line in light blue and I want to adjust the price. So my order is here. Now about the stop loss, I want it below the support. So let's say something like 0.73 and I'm going to adjust the price and also color this line in red because this is a stop loss. It's time to talk about take profits. In this case, it is very hard to place a take profit because we have lower highs on the market highlighted by this downtrend line, and this is a formation that is called descending triangle. But I don't really want to talk about it now. I just want to follow what the candlesticks are saying to me right now, and they are saying that we might have a reversal on the support. So what I'm going to do is to place the take profit higher than this highs here, probably around this highs here, so around 0.7390, and I'm going to change it. I want a green color first of all, and I want to adjust the price. So we will have a position like this with 35 pips that we risk as a stop loss and 55 pips that we have as a potential take profit. So almost 1 to 2 as a risk to reward ratio. I'm going to open then this position on my Oanda web platform. I have had some problems recently because they were obliged to change some rules. I had my account in pounds and I had to change it in euros. Then I needed to lower the leverage from 100 to 50, but it is still okay for me. It's not a big deal. So I want to open a buy position and set a market order with a stop loss at 0.73 and a take profit at 0.7390. What about the units? I want to risk 1% of my account, and in this case 1% is around 172 euros. So I want a stop loss of 172 euros. To do so, I need to select the correct amount of units. Let me start from 60,000, for example. In this case, I have 202 euros, so it is too much. Let me try with 55,000 units. It is 183 euros, so still too much. Let me type 50,000 then. It is 167 euros, so just a bit more. Let's try with 52,000 and it is okay, so I can click on submit. Here we have our position on the market, 52,000 units, long position, and I have a stop loss and take profit already set on the market. So I can just follow what happens on the MetaTrader. Okay, the position is over, but I have had some problems with the MetaTrader on Oanda. You can see that the price is not moving at all and I have no connection. To analyze this position, I'm going to switch to another platform that is called TradingView. You can see that after the buy position that we opened around here, the price went up and finally today it reached the take profit at 0.7390. So a very nice trade with a very nice profit, and if we open the Oanda web platform, you can see our trade here on Australian dollar Swiss franc for a total of €230 and 51 cents.
The moving average is one of the most popular indicators used by technicians. We have three different types of moving average: the simple moving average, the weighted moving average, and the exponential moving average. The simple moving average is just the average of all the prices selected. For example, let's say that we want to calculate the last 5 closing prices for euro-dollar. The first candle closes at 1.15, the second closes at 1.17, the third at 1.1550, the fourth at 1.16, and the fifth at 1.1650. So we need to do 1.15 plus 1.17 plus 1.1550 plus 1.16 plus 1.1650, and everything must be divided by 5, and we have 1.16. The general formula is a summation with k that goes from 1 to n of pk and everything divided by n, where n is the number of candles that we decide to analyze. So what if we want to analyze last 5 candles? This simply means that n is equal to 5 and you need to add all the prices starting from the first one, where k is equal to 1, till k equal to 5, that is last candle's price. Once you add all the prices, you divide by 5 because n is equal to 5. Don't worry, this doesn't mean that you have to get a degree in mathematics to use the moving average. I have introduced the formula just to let you understand better what I'm going to explain later on. Anyway, why do we call this indicator moving average and not just average? This is because every time that a new candle is formed, this replaces the oldest candle that was included in the calculation of the average. So let's take back the previous example. These 5 prices refer to the closing prices of the last 5 candles. When a new candle is formed on the market, the moving average will automatically replace the oldest price with the new one. So the moving average will not include 1.15 anymore in this calculation, but we will have the new price. So let's say that the new price is 1.18. The new moving average level then will be 1.17 plus 1.1550 plus 1.16 plus 1.1650 plus 1.18. And everything is divided by 5 and we get 1.1660. So the moving average is moving up after the formation of the last candle. That's the reason of the name moving average and not just average. For the simple moving average, every price contributes in the same way. So each price contributes 1/5 of the total moving average that we have calculated. This means that if we choose a small number of candles to calculate the simple moving average, the indicator will be very sensitive to every recent price action. This is good from one side because you can have a better understanding of recent price movements, but from another side it is very easy to get caught in anomalous price movements that will give you false signals. To try to avoid false signals, you can try with a longer term simple moving average that has a smoothing effect, but it will be less responsive to recent prices. So you need to try to balance the advantages and disadvantages of having a short-term and long-term moving average. If you want to choose a long-term moving average, but you are afraid that you are not giving much importance to recent candles, you can have a look at the weighted moving average. This kind of moving average assigns different weights to each price, and the most recent prices are weighted more heavily than older prices. You can also choose how to weight the data, but I'm not going into it, otherwise this will become a course about technical indicators. Last type of moving average is the exponential moving average, that can be considered a special type of weighted moving average. The exponential moving average assigns progressively smaller weights to each of the past prices. Each weight is exponentially smaller than the previous weight. That's the reason of the name exponential moving average, and this is probably the most used one by forex traders. Before having a look at how to use the moving average with the candlesticks, we need to answer to 3 questions. What type of moving average are we going to use? How many candles do we include in the calculation? How to use the moving average? The type of moving average that you are going to use is a very personal choice. For this course, I will say that the moving average that makes more sense is the simple moving average. This is simply because candlestick patterns already focus on last candle formations on the market, so there's no need to use an indicator that puts more emphasis on recent price actions. Anyway, I strongly recommend to try all the different types of moving average, so you will know better which one suits your trading strategy and which one helps you more to understand the market. I use the simple moving average when I analyze my long-term investments on a monthly chart, and I use the simple and the exponential moving average when I study other time frames. The number of candles is another personal choice. I would recommend not to go under 5 candles and not to go over 200 candles. I personally like a period of 24 candles. Why 24? I consider 24 a magic number in forex trading. It fits almost all the time frames. If you use a 15-minute time frame, 24 candlesticks will give you information about last 6 hours. If you use the hourly chart, you monitor what happened during the last 24 hours. If you use a 4-hour chart, you have 96 hours, that is exactly 4 days. So I love the number 24 in forex trading because it seems to fit perfectly every time frame. If I also want to have a long-term moving average, I choose 120 as a period. Now let's face the most important question: how to use the moving average. There are hundreds of techniques that involve the moving average. If you search for them on Google, you will find a lot of them, but I can't guarantee that they will be effective. I will show you here the most important techniques to try to use this indicator together with the candlestick patterns to understand better the market. First one is comparing the price with the moving average. This is very simple. If the price is over the moving average, we can assert that the market is in an uptrend. If the price is below the moving average, we will say that the market is in a downtrend. This is obviously very general because it doesn't include 2 necessary factors like the time frame and the period of the moving average. It wouldn't make any sense to say that the market is in an uptrend if we are studying the moving average on a 5-minute chart with a period of 5 candles. If you want to use this technique, my suggestion is to use a time frame of 1 hour or higher and a period of 24 candles or higher. The second strategy is using the moving average as support and resistance levels. Well, this doesn't need further explanation. I think it's quite self-explanatory. Last trading strategy I want to show you is called the crossover, and it needs two moving averages. One will be a short period moving average and the other will be a long period one. When the short-term moving average crosses above the long-term moving average, we have a bullish signal. When the short-term moving average crosses below the long-term moving average, we have a bearish signal. Why does this make sense? Because we have said that a moving average that includes a smaller number of candles is more sensitive to recent price action. So when the short-term moving average crosses the long-term moving average, it is showing that recently the price is deviating from long-term action. So it can initiate a new trend or simply a retracement from the main trend. Okay, I stop here to be boring with the theoretical explanations, and I'm going to show you how to combine moving average and candlestick patterns to have a better view of the market. How to use the moving average with the candlesticks. We have already seen 3 ways to use the moving average, but we are not going to use the crossover with the candlesticks. I think that the crossover is a good way to analyze the trend in the long period, especially if you use it on daily and weekly charts. But in my experience, the crossover method doesn't add much value to candlestick analysis, because the crossover appears when the trend or the retracement is already started, and with the candlestick patterns we usually try to understand from the very beginning when a new trend or a retracement is happening. So in this chart we have pound dollar, 4 hour is the time frame, and I have added a simple moving average with a period of 100 candles. First of all, we can divide the chart in 2 parts with this vertical dashed black line. In the first part we have a clear uptrend with the candles that are over the simple moving average. Then there's a break of this moving average and the price starts to go down. So we can see that in the second part of the chart we have all the candles below the moving average, so we are in a downtrend. This can be a good tool to analyze the trend on the market and select your trades according to the market direction. Of course you don't want to open short positions if the price is in an uptrend, and you don't want to open long positions if the market is in a downtrend. Then we can use the moving average as a support and resistance. You can see that the price touches the moving average here and here before continuing its uptrend. When the price is close to the moving average, you can start to look for candlestick patterns that confirm the trend. So in this case we have a bullish engulfing pattern on the moving average. It is a very strong bullish signal. Here there isn't a clear signal to buy the couple. We have a hammer here, but it is quite small compared to the previous candles, so I wouldn't have taken that one. I'm particularly risk averse, so I try to avoid situations that are not so clear to me, but maybe another trader could have opened a long position after the hammer and see what happened in next sessions. In this example I have used a 100 simple moving average because it has a smoothing effect and it is easier to analyze. So if you're getting familiar only now with candlestick patterns and moving average, I suggest to use 100 or 200 as a period. I show you what happens if you choose 24 as a period, and you will understand why it is harder. So insert and indicators, trend and moving average, and 24 as a period, and I want to get at least an exponential moving average because I have a short period. It is in a way more accurate, but price will break more easily the moving average, and you will get a lot of situations where you need to analyze deeply the market structure to understand if it is a real break or just a temporary retracement from the main trend. Now, I don't want to be vague, just saying that you can be always right if you study deeply the market structure. There are traders that say that they know exactly when it is a false breakout and that they are almost 100% of times right about their decisions based on the moving average. I honestly don't believe that. The reality is that sometimes it will happen to lose your position, because the market doesn't always follow your analysis. It is something that you need to accept, whether or not you trade with the moving average. You can see that in this first part you will have a lot of tough decisions to make, and it is normal to get caught in some bad decisions that will cost you money. But in this second part, the moving average acts perfectly as a resistance, and I'm sure that traders that use the moving average made a lot of money from this scenario. The best thing about forex trading is that you can always go back in the past with the chart and analyze what settings work better for you and help you to take the best decisions on the market. So you analyze past charts and see that the moving average with 24 candles doesn't work for you. You can have a look at 100 period then, or you can switch to another type of moving average. RSI stands for Relative Strength Index, and it is one of the most popular oscillators. Before talking about the Relative Strength Index, I need to spend a couple of words about the oscillators. What is an oscillator? An oscillator is a technical analysis tool that confines the price between two extremes, 0 and 100. So the oscillator uses an algorithm to convert the price on the market into a value that ranges between 0 and 100. This time I'm not going to analyze the formula to build the relative strength index, even if it is not complicated, but I think that I can give you some guidelines to use it that are much better than the formula. The RSI is calculated comparing the gains of the up sessions with the losses of the down sessions over a given period. What does this mean in a practical way? This means that the relative strength index is very sensitive to candlestick movements, so the bigger the candle, the greater the variation of the RSI line. Let's see an example on the MetaTrader. We have dollar-Swiss franc on a 30-minute chart, and you can see how this candle moves the RSI. With just one big red candle, the RSI goes from 56 to 32, 24 points with just one candle. You can notice that no other candle has such a strong power to move the oscillator in the same way. So the RSI is very sensitive to candlestick movements. A big candle can have a huge impact on the calculation of the value. Before checking how to use this oscillator, I'm going to share an interesting research about the setup of the RSI. When you open the oscillator on the MetaTrader, you can see that the standard setup is apply to and then close. In this way, the prices that are going to be included in the calculation are the closing prices. But I want you to think about this. When you have a trend and the price is forming new highs and new lows, do you check them on the closing prices or on the shadows? We check the highs and lows on the shadows, not on the real body. So long time ago I tried to use the RSI in a more logical way, or at least more logical to me. I went beyond the standard setup of this indicator and I decided to apply the RSI to high when there's an uptrend and to low when there is a downtrend. Let's check on the MetaTrader how the RSI changes. Here we have Eurodollar on a daily chart and you can see that there is a clear uptrend. The RSI is calculated on closing prices. Let's draw a vertical line when we have new highs on the market. So starting from here, we have the first high here, then another one on this green candle, Going on, we have another high on this red candle, then another one here, and last one here on this green candle. I zoom in and we can check if the new highs on the chart match with the new highs on the RSI. Here we have the first high and the line on the RSI is going down, so it doesn't match. Here the high on the chart matches with the high on the oscillator. Going on, we have a new high here and the line on the RSI once again is going down. Again on this new high, the same situation. Then on the last high the RSI is going up, but it doesn't form a high. You can see that the high is here on the next candle. Now let's go back and see what changes if we apply the algorithm to highs and not to closes. The first vertical line matches, the second matches, the same for the third, the fourth is the same, the fifth matches once again. It is far more accurate. So when you open your RSI, I suggest to leave all the settings like that. A period of 14 candles is fine, but adjust this setting according to the trend on the market. If there's an uptrend, you will have a better view selecting high. If there is a downtrend, you will have a better view selecting low. Having said that, it's time to check how to use this oscillator. There are two main uses of it. The first one is as an overbought and oversold indicator. This is the most common and it is typical of all the oscillators. When the line approaches the 70 level, we say that the couple is overbought and a down move could start. When the price approaches the 30 level, we say that the couple is oversold and an up move could start. This kind of analysis usually works when the market is in a sideways trend, but it's not very useful in situations of strong uptrend or downtrend. The second way to use this oscillator is as a divergence tool. What is a divergence? A divergence happens when the oscillator is not giving us the same information of the chart. When the price makes a new high and the RSI fails to make a concurrent high, we have a negative divergence, that is a bearish signal. When the price forms a new low but the RSI doesn't, we have a positive divergence, that is a bullish signal. Here on Eurodollar daily chart we have a down move and I have the RSI applied to lows. We have a first low here on this candle, another low is here on this candle, and the last low is on this red candle. On the chart we have lower lows, but if we are going to check the RSI, we can see that the value is increasing at each new low. This is a positive divergence. The RSI is telling us the opposite of the chart. So on these two candles we could consider a long position, and actually you can see that the price then starts to go up.
Here we have New Zealand dollar against United States dollar on a 4-hour chart. In the second part of the chart, we can find higher highs and higher lows, so we can say that the price is in an uptrend. Let's add the relative strength index and check if we can add more value to this analysis. So, insert, indicators and relative strength index. I want to apply the oscillator to high because the price is in an uptrend. So here we have the RSI and I'm going to draw my vertical lines to check each high. The first one is here, then we have another one here. Going on, another high is on this green candle and the last one is here on this candle. On the RSI, nothing weird between the first two highs, the value is growing. Then on this new high, the RSI is at a lower level compared to the previous high, so we have a divergence. So at this point, we can start to look for a candlestick pattern that gives us a good chance to enter a short position. Right here, we have a bearish engulfing pattern, so this is the first good chance to open a short position. Then here, right on the divergence, we have a shooting star that is another amazing opportunity to open a short position. Going on, we see that actually the price went down and our analysis with the divergence was correct. Maybe we had a new high here. I'm going to draw another vertical line. This new high actually forms another divergence because the RSI line is lower than the previous level, so it only confirms our view of the market. As you may have noticed, trading with the divergences let us take the trade against the trend, trying to catch a new trend. This is not something that I usually suggest, but I don't want to close the door to new opportunities. So my advice is try it. You never know what is going to work for you if you never try. You have a demo account where you can try different strategies for free, so you have nothing to lose. Practice, 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 and see if it's going to work for you. I want to ask you a question. What do you think it has been the most important concept in this course? I can already imagine you saying reading the market with the candlesticks or how to place stop loss and take profit correctly. But in my opinion, the answer is another one. The most important concept is that there is not a standard situation that always happens on the market. Every scenario is different and needs to be analyzed on its own. This is the reason why this lecture is called How to Build a Trading Strategy and not How to Build a Trading System. You want to have a strategy to consider some entries when you analyze the chart, but you don't want to have a system that is made by a bunch of rules that you always apply regardless what the market is really saying. Having said that, you are 3 steps away from building your own strategy. Step 1 is choose the correct time frame for you. You can be a scalper, you can be a day trader, you can be a swing trader, you can be a position trader. It doesn't matter. You are the only one that can decide which time frame suits you better. We have already talked about the time frames, so I'm not going any farther and we can jump to the second step. The second step is choosing your weapons to face the market. We have seen everything possible about the candlesticks, so candlestick patterns will be a huge weapon by your side to win the war against the market. Do you want to have something more on your chart to filter the signals? Well, sure, you can do it. Go on. We have seen the moving average, we have seen the relative strength index, we have also analyzed different settings for these indicators. A common mistake is to think that the more the better when choosing how many indicators to use. Do you think that something like this is better than something like this? You should use whatever can help you to analyze the market, but this doesn't necessarily mean that you will have a better understanding of the market if you use more indicators. There are many expert traders that only use the candlesticks to trade. They don't use any other tool. It's just a matter of finding out what is the best setup for you. Step 3 is write down your money management rules. For example, I never risk more than 1% per trade, and I never choose a risk to reward below 1 to 1. How you manage your account and your risk plays a fundamental part in your strategy, so make sure to spend time to define your rules. So you've got 3 steps to build your own strategy, and honestly, you don't need to be Einstein to come out with a strategy that works. But then how to proceed? Are you going to invest $50,000 on this strategy? Of course not. You need to test your trading strategy. The easiest way is to open your MetaTrader, go back in time with your chart, and then move the chart forward, starting to analyze all the positions that you would have taken in the past. Record your results and be honest with yourself. At the end, when you have your final results, if you are happy with that, you can go on and use that strategy with a demo account for a couple of months. Trading with the demo account will put you in a different situation because now you're dealing with a market that is moving. If your results are still good after a couple of months of demo trading, then you can start with a real account. I have had a question from a student a time ago and I thought to record a video for it because I have seen that this is becoming a popular topic among traders. What kind of laptop do you use for trading? How many screens do you have? Do you use your laptop exclusively for trading? These are the questions that I get the most, and I can understand why everyone wants to start at the best with the right tools. I tell you that you don't need to spend thousands of dollars to get the right equipment. Chances are that you don't have to spend a single cent. What kind of laptop do I use? I have two laptops. One is an Acer. I don't get into the details of it, but I tell you that it is a very normal laptop, even a cheap one, since I paid around £400 for it in 2015. The other one is a MacBook Pro that is an amazing laptop but more expensive. I paid in euros and I paid around 3,000 euros with a 15% discount. The difference between them in terms of trading, absolutely nothing. I will say that the Acer is even better since it is not easy to find the MetaTrader 4 for the Mac. So I understand that you want to set everything up before starting your trading career, but I'm 99% sure that the device that you are using right now to follow this video is more than enough to trade in the Forex market. No need to spend a lot of money for a new laptop or a new computer. How many screens do I have? This is a funny question because when you see traders on YouTube who claim to be professionals and make millions per month, you see them trading with 6-7 screens at least. I tell you that I only have one screen. I only use my laptop to analyze the market and switch from a chart to another. If you feel the need to check multiple charts simultaneously, then buy a new screen, have 2, 3 or more than that if you want, but in my opinion there is no need to spend money when you can pass from one chart to another, from one time frame to another with a simple click. Last frequent question is, do you use your laptop exclusively for trading? Yes, I use one laptop only for trading, and the reason is because I'm afraid of doing other things on the internet while I have my account opened with my money in it. This is the only part in which I preferred to differentiate. I bought a new laptop only when my trading account was already quite big to allow me to live off Forex trading. So I will not suggest you to spend money in a new laptop to dedicate to Forex trading before starting your journey. Start practicing now, see how it goes in a few months, and then you can structure your business and maybe give yourself a treat if things are going well. So my final advice is start with the laptop or computer or even mobile phone that you already have. So in this course, we have used Oanda as a broker. It is easy to use and it doesn't have any minimum deposit or minimum position size, which makes it perfect if you just want to test the waters and see if you can successfully apply what you have learned so far in this course. What if you don't want to use Oanda, or what if Oanda is not available in your country? In the live trading section, you have already seen a few good brokers that I personally use or have used in the past, but what if you want to browse some other brokers on your own? How do you find a good one? First of all, I recommend you have a look at this website, forexpeacearmy.com. It is a website where traders post reviews of brokers they use or have used, sharing their experience with a community of thousands of traders. To see the list of brokers, you can hover your mouse over reviews and then click on Forex brokers. Here, you can apply several filters. For example, you can choose to view only brokers with a minimum rating of 3 stars out of 5, as we all want reputable brokers with good reviews from other traders. Let's apply the filters and we have our list of brokers. The first 3 are just ads, so let's see the first one after the ads. It is Global Prime, so we can click on it and we will have all the details about this broker, including regulation, maximum leverage and minimum deposits. If we scroll down, we have all the reviews left by other traders. So Forex Peace Army can be a great help when choosing your Forex broker, but I have also put together a list of brokers that I use or have used in the past. You can find the list of brokers in the resources for this lecture. As you can see, there are some bullet points so you can have a quick look at the pros and cons of each broker and my review based on my personal experience. The world of trading is constantly evolving, so I always try to keep this list up to date. Being an instructor on Udemy allows me to leverage some deals with some brokers, so you can also benefit from it. All the promotions are disclosed in the file attached to this lecture. Signing up with a good and reliable broker is certainly an important step, so take your time to decide which one you're going to place your business with, and please let me know if you have any doubts. How to upload a template to your MetaTrader 4. When you open the MetaTrader for the first time, you have something like this. You have noticed that my MetaTrader charts are completely different. They have another style, another template. I don't have green bars, I don't have a black background, and it simply looks very different from this one. So if you don't like this kind of template, the standard one, if you want to personalize the chart, you can use the right click and then properties and change the settings that you want. You can also apply the same settings that I have for my MetaTrader 4, but if you like my template, you have an easy way to upload it in a few seconds. First of all, you need to download the template that you will find in the resources for this lecture, then save it on the desktop, the MetaTrader file, or wherever you prefer, then right-click, template and load template. I have saved my template as template name, so very basic, nothing special. You just need to select it and open. Here we go, you have now the same template that I use to analyze the charts. In my opinion, it is much better. You can clearly see the color of the candlesticks. Is it something difficult to save your own template and use it for all the currency pairs? It is extremely easy. Let's suppose that you want to add an indicator. So insert indicators. Let's check trend, for example. Actually, I want to add the stochastic oscillator. So let me find it here in the oscillators. And here we go. We have the previous chart plus the indicator. Now, this is just for euro-dollar, but when you open a new chart, let's say that you want to analyze dollar-Japanese yen, you will have the same standard template of the MetaTrader 4. What you need to do is to go back to euro-dollar chart, right-click and then template. Oh, I was selecting time frames. So template and save template. You can give a name to that template. I'm going to save this one as stochastic. When you open a new chart like this one on dollar yen, you only need to select the template, load template, and then stochastic. So open and you have exactly the same style that you have with the euro-dollar chart. White background, green and red candles, and the oscillator with the same settings. So you don't need to right-click properties and change them for all the charts. When you are happy with the style of a chart, you can save the template and upload it to every other chart that you want to analyze. If you want the same template that I use, don't forget that you can download it in the resources for this lecture, and it will take just a few seconds to upload it. Here we have pound dollar on a daily chart, and I have received a question from a student: how to draw support and resistance. In this video, I'm going to show you how to draw support and resistance in order to be sure that you will not miss any key level in the future. The technique that I'm going to show you is based on turning points, or you can call them swing points. What is a swing point? It is just a point where you can see that the price deviates from its direction, so simply a point where the price changes direction. Let's try to identify all the swing points and also draw a line that may work as a support or a resistance. Starting from here, you can see that the price was going a bit up and then suddenly changes direction and starts to go down. This can be identified as a turning point, so I can draw my first key level here. Then the price goes down until here and it changes direction again, so another swing point is here and I draw my second horizontal line. You don't need to be extremely accurate with the lines because support and resistance are areas of price, they are not exact prices. Then the price goes up until here and I can draw another line because this is another turning point. Let me try to fix this. Okay. As you can see, after this level, the price starts to go down until it reaches this point and it changes direction again. So we have another swing point here and we draw another line. Then it goes up and down. It is between two key levels in a sideways trend, I will say. Then it goes up until here and we can draw another line to identify this level. It's not like a major swing point, but it is better to consider it. The price goes back to this support, it goes up again and stays for a while on this level before going up until it reaches a new high here, and we can draw another line. The price goes back, we can identify here another swing point and so a key level. I'm going to draw a line. Then it goes back, but it is pretty much on this line, so I'm not going to draw another one. The price goes down until here then, so I will draw another line to identify this key level. The price goes up again until here and we have another level. Then it goes a bit up and down between these lines, down again on this level and up again on this other level. It reaches then another important level here, goes back on this support, goes back on this resistance, and it goes all the way down until here where we have another support. You can see that this support was working for a while and was stopping the downtrend, but then the price went down anyway and now it is on another good support. Now you have many lines. I will keep all of them, but if you want you can change the color for the ones that seem to be more important. Remember that the more the price has been rejected by a support or resistance, the stronger the level. So you can identify the levels that have worked in the past and change the color for them to give more importance to those levels. For example, I can see that this line worked quite well as a resistance here, and then it worked very well as a support, at least a couple of times here. So this is a very important level. Probably this one is not so important at the moment because we didn't have any other chance to verify if this is a good level because the price only went there once. So this is how you draw support and resistance. At the moment, the price is close to an important support, and if we zoom in, we can also see that there is an important bullish signal. There is a bullish engulfing pattern, so this represents a great opportunity to enter a long trade. How to draw a trend line. First of all, we need to clarify that drawing an uptrend line is different from drawing a downtrend line. When you draw an uptrend line, you connect higher lows, so the line will be below the price. When you draw a downtrend line, you connect lower highs, so the line will be above the price. Here we have a Euro Australian dollar. It is clear that we are in an uptrend, but let's define it by drawing a trend line that can also be useful for future trading decisions. To draw an uptrend line, I need to connect higher lows. So starting from here, I draw my first line trying to connect these two lows. When you draw a trend line, you also need to check if it has any significance for future prices. In this case, you can see that here the price crossed a bit the trend line, not that much, but here it happens again and it is even worse than before. Even if we go farther, here for example, the price simply doesn't respect the trend line, and so this trend line doesn't have any particular meaning. We can also delete it. Let's try, for example, to connect these two lows. Is this trend line more significant? Let's see if the price respects this trend line. Here it breaks the trend line, and here again, and here even worse, and probably in this area the trend line worked a bit as a resistance, and at the end it worked for a small period as a normal trend line, but overall I will say that this trend line also doesn't have any particular meaning. It simply never worked and never was a good trend line. Let's try to connect these two lows here, for example. As you can immediately see, this kind of trend line is much better. Starting from here, we have a second touch here, and then many times the price tested the area around the trend line and got rejected. Once again in this area, so let's check what happened next. You can see that here the price went a bit under the trend line, even if not that much. Remember that the trend line is an area just like support and resistance, so you shouldn't expect that the price hits the line and immediately bounces back. It's not an exit price, it is an area. After this period, the trend line starts to work again perfectly. Here it goes up, it comes back, and then it goes up again. Then it comes back on the trend line and bounces back. At the end, the price breaks the trend line and starts a new down movement. So my advice is try to connect higher lows in case of an uptrend or lower highs if it is a downtrend, and check if your trend line has any significance at all. This means that after the first 2 points, there must be at least a third point that clearly respects the trend line, pushing the price back. How to draw a channel. We are on dollar Japanese yen. It is a weekly chart, and the first thing that we can notice is that the price is going slowly down and we are currently in a downtrend. What we will normally do in this situation is to draw a downtrend line to connect lower highs. So I draw my line here connecting these two highs. Now when you draw a trend line, sometimes you have a feeling that on the other side you can draw exactly the same line to connect some important points. In this case we are in a downtrend. I drew a trend line to connect lower highs, but I immediately have a feeling that I can draw the same line to connect the lower lows on the opposite side. In this case, instead of having a trend line that I'm deleting, you can click on this button here and it will draw a channel. Let's start by drawing the same trend line. I'm drawing exactly the same trend line that I had before. Now we have another line here that is parallel to our trend line. With this line, we can try to connect the lower lows as well. So we will have something like that. You can try to place it on one of the lows here, for example, but it doesn't look very nice. Let's try here. It looks much better. We can try with this other low and it looks perfect. So I will keep it like that. There is no general rule to build a channel. You just need to develop an eye for it with practice. Also, sometimes you can draw a very good trend line, but you can't build a good channel because the situation on the opposite side is different and a parallel line would not make any sense.
What is correlation? Correlation is a statistical measure of how two variables are related. In forex trading, correlation is a measure of how two currency pairs are related. I'm sure that sometimes you have noticed that two currency pairs seem to go in the same direction. This is called positive correlation. Sometimes currency pairs seem to go in the opposite direction. This is called negative correlation. The correlation coefficient ranges between -1 and +1. With +1 we have a perfect positive correlation. This means that the currency pairs move exactly in the same direction all the time. With -1 we have a perfect negative correlation, which means that the currency pairs move in the opposite directions all the time. Let's have an example. Dollar against Swiss franc and dollar against Canadian dollar have a correlation coefficient of 0.31. What can we say about it? It is a positive correlation, but not too strong. So these two currency pairs sometimes have the same movements, but it doesn't happen often. To understand better how correlation works, it is important to analyze single currencies and not in a pair. So we have pound, United States dollar and euro. The strongest one at the moment is the pound. The second one is the United States dollar, and the last one is euro, which is very weak at the moment. What if we open a long position on pound dollar and a short position on euro dollar? Many traders will tell you that it doesn't make sense because these two currency pairs have a strong correlation. It is hard that you will have a profit from both of your positions. If you have a look at the list, the pound is gaining against the United States dollar because it is stronger. The United States dollar is weaker than the pound, but it is stronger than the euro. A long position on pound dollar and a short position on euro dollar would be both profitable in this case. Of course, the best option for you in this scenario would be a long position on pound euro or a short position on euro pound if you prefer. It is exactly the same. If we check a correlation chart like this one on Oanda, we can see that there is a strong correlation between euro dollar and pound dollar. 1 hour and 1 day don't count for now because I'm recording this video on a Sunday, so they are 0 and 1, but if you check all the others you can see that there is a strong correlation between them. This can be explained once again looking at the single currencies instead of considering them in a pair. Euro dollar and pound dollar have both the dollar in common. This means that if the dollar is very weak, probably euro and pound will both gain against the dollar. If the dollar is very strong, euro and pound will both lose against the dollar. This leads us to my first advice. Avoid to trade correlated currency pairs in days with important news, if the news is about the currency that is in common in both of your potential trades. If there is an important news for the United States dollar, like the non-farm payrolls for example, you can be sure that the dollar will drive the market, so the correlation will get stronger. So if you're thinking to open a position on euro dollar and pound dollar on the day of the non-farm payrolls, it is probably not a good idea. Another important thing to consider is the time horizon for your trade. Usually, correlation is not so important if you plan to close your trade in minutes or hours. It becomes more important if you're planning to keep your trade open for days or weeks. Here we have two charts, euro dollar on the left and pound dollar on the right. Both of them have a 5-minute time frame. You can see that even if you can find some similarities in these two charts, Euro-dollar is going up, forming higher lows. Pound-dollar seems not to have a clear trend at the moment, and anyway it is forming lower lows, so just the opposite of Euro-dollar. If we increase the time frame like 4 hours, we can see that it is very easy to find a correlation between these two currency pairs. Movements are very similar, and in general the market seems to follow the same direction. So, the final question is, should you open trades with currency pairs that have a strong correlation? The answer is, it depends. If you have important news during the day that can affect the currency pair that is in both your trades, maybe it is better to trade just one currency pair. If you are planning to keep your trade for several days or several weeks, then once again probably it is better to open just one trade, or another solution could be to split the risk between those two currency pairs. If it is not one of the cases that I have mentioned, I think that correlation is a bit overrated and I honestly don't really mind about it that much.
This is a bonus lecture that I decided to record and put in this course after replying to a question from a student. We have Euro New Zealand dollar on a 15 minutes chart, and you can see that in the first part of the chart we have a downtrend, but then we have a congestion phase with the price ranging between 1.7070 and 1.7170. If we go on, we have a super strong bearish candlestick. Let me also zoom in so it will be clearer. If we analyze the single candlestick, we will say that it is almost a bearish Marboso, strong sign of a continuation of the previous trend. But this is what I call a false candlestick. This is a candlestick on the 15 minutes chart that covers 150 pips in just 15 minutes. Definitely an unusual movement that is probably created from speculating on an important news on the New Zealand dollar. This is not a candlestick that can be compared to the others, and it may be a bit misleading. Let me give you an example of what in statistics is called a truncated mean or trimmed mean. We are trying to calculate the average salary in the United States, so I call 10 random people and ask them if they can share with me the exact figure of their salary. Let's say that the average is $2,000 per month. I do it another time calling other 10 random people and I happen to digit the number of Bill Gates. This time the average is $50,000 per month. Is this a good representation of the average salary in the United States? Not really. That's why in statistics they invented something called the truncated mean or trimmed mean. You call the 10 people, ask for their salary, and then you cut the lowest and the highest value before performing the average. In this case, Bill Gates' salary is going to be cut before performing the average, so you avoid to include this kind of exceptions in your sample. Now here on Euro New Zealand dollar we have a candle of 150 pips where all the others are about 10 pips. I believe that this is a false representation of what usually this kind of candlestick tells you. This is a fast action, probably on an important news. It shouldn't be treated as a normal candlestick. The question was, should I take my profits after this candle or should I expect the downtrend to continue? I will take my profits, to be honest. Here we can't really talk about trends. This is just speculation pushing the price down very fast, so I wouldn't analyze this candle to look for a sign of continuation of the downtrend. I believe that these other candles that follow are more important to evaluate the trend. We have several attempts by buyers to push the price back up, but we have two reactions forming two bearish bearish engulfing patterns. Then we have a shooting star with a very good upper shadow that shows that sellers are reacting on this level, and then another candle with another upper shadow that shows a great reaction by sellers. I believe that this group of candlesticks is more important than this one to evaluate a possible continuation of the downtrend. So when you have a candlestick like this on the market, extremely different from all the others, like 15, 20 times bigger, consider to analyze next candlesticks to evaluate the trend, and don't trust a forced candlestick like this. I get this question a lot. So can I use the candlestick patterns and the candlestick logic to analyze other financial markets? Yes, you can. Here we have an example on the stock market. The chart is Alphabet, that is Google. The time frame is 4 hour, and the first thing I can notice is that there is a down channel here that I'm going to highlight like this. Can you spot any candlestick pattern that suggests a trade on this channel? There is a very strong bearish engulfing pattern right at the top of the down channel. This is a very good signal to enter a short position, and you can see that the action that follows confirms our idea. We have a strong bearish candle that confirms that sellers are strong, and then another red candle with buyers that start to appear. That's why we have this lower shadow. So, can you apply the concepts in this course to other financial markets, like the stock market, for example? Yes, you can, but make sure to study the main features of the market that you are going to trade. For example, the stock market has much more gaps compared to the forex market. You can see an important gap here and others along the way. So, you can use the candlesticks to analyze any other financial market, but make sure that you understand the market that you are trading.
Okay, this is a trading journal that is very similar to the one that I have, and you can see that we have a first page trading journal. You can insert your positions here, and then we have statistics that we are going to check in a couple of minutes. First of all, we have initial balance here, and you can adjust this however you want. For example, if you want to start with $500, just type 500 and you will have it. Excel will automatically change all the necessary data in the file. If you want to have, for example, $10,000, once again Excel will adjust the other cells. Let me enlarge a bit this one so we can see the number. Okay, let's assume we have $1,000 in our trading account. You can see that I already have a position here, and when you download the file it will be like this. Don't select all and press cancel on your keyboard, because there are cells that contain a formula. So whenever you want to cancel something, don't cancel the risk to reward ratio and the balance, because you can see that there is a formula here. So if you delete this, you will also lose the formula. The same for the balance. As I said, you will already have a first line here when you download the file in the resources for this lecture. You can just overwrite on the cells. Let's say that you want a trade on the 15th of February 2019, so I leave this like this, but I want a different currency pair. I want a euro against the US dollar. Then here you can select long or short. Let's open a long position. Then we have size. You can either type the volume like on the MetaTrader, so 0.05, 5 microlots, or you can also type 5,000 units like we usually do on the Oanda web platform. It is totally the same, it is up to you. I prefer 0.05, then price, let's say 1.1320, stop loss, it is a long position, 1.13, so 20 pips as stop loss, while the take profit at 1.14. You can see that the risk to reward ratio is calculated automatically, and it is 1:4 for this position. Then you see how the position goes and you type the profit or loss here. Let's say we had a profit of $70, and you can see that the balance automatically changes. Let's have some other trades as examples so we can have a better look at the statistics. Same day, this time a pound against the US dollar, we want a short position for 0.04. Price is 1.3150, stop loss let's say 1.32, and take profit same 50 pips, so 1.31. We have a risk to reward ratio of 1 to 1. This time we lose, and we lose, let's say, $15. The balance automatically adjusts here. New trading day, 18th of February 2019, we want to have a US dollar against Swiss franc, and we want to have a long position for a total of 0.10. We take a price of 1.01, stop loss at 1.0050, so 50 pips, and take profit at 1.0190, for example. We have a risk to reward ratio of 1 to 1.8, and we lose again, let's say $20. Another trade, the next day we have, let's say, I don't know, gold, a long position, just one contract, the price is $1,300, stop loss at $1,200, and take profit at $1,500. Let's say we lose just $30, for example. It is not the case because we are trading with a whole contract, but it is just a quick example to have a look at the statistics. Last one, I want again a euro against the US dollar. It is very convenient because Excel recognizes that you already have something similar in your file, so you don't even have to type the whole name again. This time I want a short position for 0.06. Price is 1.1350, stop loss let's say 1.14, and take profit, let's say that we have a long-term position, so 1.05 as a take profit, with an amazing risk to reward ratio of 1 to 17. We have a very good profit for this trade of $250, and we end up with a nice profit after 5 trades. Let's check the statistics. You can see that I didn't insert many things, but I really like to have only important figures in my files. We have number of trades 5. If we check our trading journal, we have 1, 2, 3, 4, 5, so correct. Then winning positions 2, once again correct. One is here and the other one is here, with 3 losing positions. Everything is correct, and the win percentage is 40%. In this trading journal, you can see something different, the total amount of money that you get from your winning positions and the total amount of money we lose with our losing positions. Why is that? Many times we tend to analyze the win percentage in terms of positions that we have won or lost. When we see that the win ratio is below 50%, we think that the strategy is not profitable, or it is not good enough anyway. This would be correct if we traded with a risk to reward ratio that is always 1 to 1. In that case, we should really achieve a win percentage of 50% or above that, otherwise we will have a loss in our trading account. Many times we trade with a risk to reward ratio that is better than 1 to 1, so we could have a profit even with a percentage that is below 50%. That's why I created this win percentage with the money we win or lose. If this one is above 50%, the strategy is profitable. If this percentage is below 50%, the strategy is not profitable. Simple as that. In this case, we have 83.12%, so the strategy is making money, and if we check the trading journal, it is like this. We started with $1,000 and we have $1,255, so this is making money. But if you check the win percentage in terms of trades, you might get confused because it is below 50%, it is 40%. Last statistics I have is the drawdown. Right now it is minus 6.07% because we had this losing streak here. You can notice I haven't inserted any statistic about the number of pips, like number of pips you are winning or losing, etc. This is because I don't believe it is quite useful. Sometimes we risk 1% on a stop loss of 15 pips and sometimes on a stop loss of 100 pips. So the value of a pip is not the same for all the trades that we have, and we might as well have a negative amount of pips at the end of the month but still have a profit. Another reason not to insert this statistic is because I will need to add the other 2 or 3 columns here and it may look a mess. If you have any requests about some statistics you want to see in this file, just let me know in the question and answer section. I'm not an expert with Excel, but I will try my best.
Okay, let's have our last talk, this time not from a teacher to a student, but from a friend to another friend. The first thing I want to say is that I'm always super proud when I see my students marking every single lecture as completed. Most people don't know this, but only 30% of students complete online courses, so first of all you are in this percentage. Then this is not a course that you could take without having a basic knowledge of forex trading, so I assume you took my first course, or anyway you built your knowledge in another way, you took action trading on the market, and then you landed here. And I'm super proud of this, because this shows that you have the right attitude to become a successful trader. You are curious, you always want to learn, you never stop, you are hungry for success, and believe me that I really mean it when I say that I'm super proud of you and of all the students that end my courses. It usually happens at the end of the course to ask yourself, okay, now how to apply this? My personal challenge for this course was to give you something more than a list of patterns, and I hope I succeeded in this and you have now a better understanding of the market and of the forces that hide behind the price movements. I also hope that you got to know me better during the course, so now you know that I'm always available to help you with any question and any doubt that you may have about forex trading. So I encourage you to write in the discussion board and get the most out of this course. Remember that if you fail as a trader, I fail as an instructor, so I will give you my best to help you succeeding in your trading career. In addition, this course gives you a lifetime access, so take the time to go through the lectures as many times as you have to. Last thing that I always mention in my courses, usually we say knowledge is power, but especially in forex trading, I believe that applied knowledge is power. So make sure to practice these concepts with your demo accounts. Okay, so now the course is coming to an end and you can start to apply what you have learned. How many millions of dollars are you going to make? 0. Becoming a top trader is a process that can take 3 months, 6 months, 1 year, or even more. You can't expect to be a beginner, take the course, and wake up tomorrow as a money machine. Now you have all the tools to face the market and become a profitable trader, so I can only give you my last advice, maybe the most important one. Be constant in what you do. How many things have you started in your life and left there incomplete? Maybe a tennis course that you haven't finished, your dream to go somewhere in the world, your plan to start a new business. It's easy to start, then for some reason we lose our enthusiasm and leave our work incomplete. Don't let forex trading be one of these. Let it be your masterpiece. Dedicate at least 20 minutes per day to forex trading. Be constant and you will see the results.
Bybit Referral Code 2026, new Bybit 30,000 welcome bonus and promo code. In today's video, I'm going to walk you through the best Bybit referral code and how you can use it to get started with some really solid bonuses. All you need to do is go through the link in the description or the pinned comment below. That link will give you access to the best referral benefits so you can get a strong start right away. The referral code is 16818. So again, the best Bybit referral code right now is 16818, and if you use the link below, it should already be applied automatically when you sign up. Now, the sign up page might look slightly different over time, but the process is always the same. Just create your account and you'll be eligible for the welcome rewards. At the time of recording this, you can get up to $30,000 in bonuses. That includes a sign-up bonus, deposit rewards, VIP upgrades, and more. Once you land on the sign-up page, just enter your details and click to claim your rewards. It's actually pretty straightforward. Bybit itself is a well-established platform. There are millions of users worldwide, support across many countries, and a wide range of listed tokens. You can trade spot, explore different trading pairs, and even use derivatives or leverage products if that's something you're interested in. They also offer 24/7 support, strong liquidity, and a unified trading account system, which makes everything much smoother. Now, one more time, just to be clear, if you use the link below, the referral code 16818 should already be applied automatically. If for some reason it's not there, just enter 16,818 manually in the referral code section. I'll also leave the code in the description and in the pinned comment so you can easily copy and paste it. And that's pretty much it. Here is a quick walkthrough to help you get started with Bybit in exactly the right way